Good morning, everyone. On behalf of the ISO, I'd like to welcome you to the Congestion Revenue Rights Enhancements meeting to review stakeholder feedback in the working group so far. My name is Hannah Pearson, representing ISO Stakeholder Affairs, and I'll be facilitating the web conference today. Next slide. Just some housekeeping reminders. This call is being recorded for information and convenience purposes. Any related transcripts should not be reprinted without the ISO's permission. Please keep comments professional and respectful. Please try and be brief and refrain from repeating what has already been said so that we can manage time efficiently. Next slide. To ask questions during the meeting, you can open the participant and chat panels on the bottom right. You can then raise your hand by selecting the raise hand icon, or if you're joined by audio only, please press *3 on your device. And for everyone joining us today, please state your name and affiliation first before speaking, and you can also send comments and questions via chat to all panelists, and then also to myself as well. Very next slide. Okay, and then here's a look at the agenda. So we'll start with opening comments from Partha and Hillary, and then we'll go into stakeholder presentations from California LSC Group, Energy Trading Institute, Nodal Exchange, DMM, and Bay Area Municipal Transit Authority. And then we'll take a short break for lunch, and then we'll come back and do the review of analysis, requests, and discussion from Hillary, and then discussion on draft goals and problem statements, and including review of the feedback. That'll be Partha, Hillary, and Dinesh. And then we'll end with next steps and closing comments from Partha and Hillary. So with that, I will hand it off to Hillary.
All right. Good morning, everybody. I'm Hillary Staver from the Market Policy Design team. I'm joined here this morning by our principal, Partha Malviskar. And thank you, everybody, for joining us for the 6th meeting of the working group. Before we dive in here this morning, I wanted to do a quick recap of where we've been so far. You've seen a version of this slide at the opening of our previous meeting, so just to come back briefly to set us up for today. The first 5 meetings after the initial one in November focused on scoping. We spent a meeting in January looking at how the current CRR market in CAISO is structured, heard some stakeholder presentations on perspectives and experiences with the current market. That's a format that you'll see mirrored today after my comments here. In February and March, we heard from our market analysis team a really deep dive on some root cause analysis, looking at CRR market outcomes since the last round of policy changes was adopted in 2019. What's happened since then on revenue adequacy and auction efficiency, especially. Last time we met, about 6 weeks ago, we focused on benchmarking to other CRR market structures and FTR structures around the country. So we heard presentations from MISO and PJM talking about how their programs are structured and some of the outcomes they've seen on revenue adequacy. And that brings us, those first 5 meetings bring us to kind of the end of the first part of the working group, which was focused on sort of reviewing the current structures and looking at what's already been done. Today, and in the June meeting after this one, we're going to start to pivot a little bit to bring the conversation more explicitly towards kind of distilling and synthesizing everything that we've heard so far into developing some goals and problem statements that can ultimately guide the policy development phase of this initiative. So with that in mind, we go to the next slide. This is what we're hoping to provide for everybody and help everybody get out of the meeting today. We want this to function partly as an opportunity to review the conversation so far. You know, we've been meeting here now for about 6 months, and so we wanted to provide an opportunity to kind of synthesize everything we've heard so far, allow parties to add additional detail if they feel that is appropriate. We're going to hear this morning from an additional slate of stakeholder presentations, perspectives and experiences with the CRR market, and especially how that could be reflected in the problem statements that we develop here. So thank you, everybody who is lined up, has raised their hands to speak this morning. We're looking forward to hearing from you. And in the afternoon, then, we are going to touch on the analysis requests that we received in the follow-up to the root cause analysis discussions. We appreciate that there was a lot of interest in further iteration on this research, and so we'll touch on that. And then we'll bring it all together in the final portion of the afternoon to really talk about how we can distill all of this into some goals and problem statements that hopefully can facilitate some common ground development as we move into the policy development phase, where we're going to be talking about explicit consideration of changes. So with that, I will pause here. Martha, do you have any opening thoughts you'd like to share?
No, I think you covered it really well. Maybe we could open up the phone lines to hear from market participants. There's some of their feedback, because obviously we structured these meetings to kick it off really to provide that background and level settings. We can go in with the common understanding and informed as we get into that policy development phase. With that initial step being making sure that we're all sort of level set on what are the goals of the CRR program, and what are sort of the current problem statements with meeting those current goals. And we also recognize as well, just to level set with everybody, and we've gotten lots of good feedback to date, lots of diverse opinions in terms of both what we should be trying to achieve as well as what the challenges are with meeting those goals. I think we kind of came in there with eyes wide open that we might not get to 100% agreement in terms of what the right goals should be, as well as what the right problem statements, but at least having that common understanding. So particularly if there's sort of more information that people are wanting, it could be from other participants, it could be from the ISO. This might be a good chance if anyone wants to raise their hand and speak up in terms of where we're at. But we have 5 really good presenters as well, I think, who can help shape that conversation. So thanks Hillary. Maybe I'll ask, I don't know if Hannah, is there anyone on the phone who's raised their hand, or I'm not sure there's a...
No questions in the chat, and no hands raised.
Seeing none, we are ready to move on to our first stakeholder presentation of the morning. I guess we'll come back to this presentation later, but yeah, Todd Ryan, representing the California LSE Group, welcome.
All right, thank you. Okay, again, Todd Ryan, I'm representing a coalition of California LSEs, representing the Bay Area Municipal Transmission Group, BAMX, PG&E, 6 cities, San Diego Gas and Electric, and Southern California Edison. All right, next slide, please. So the key points I want to try to stress today on behalf of the group are the need to kind of balance in this initiative the 2 priorities that CRR's functions that CRR's provide, right? The reimbursement of dollars back to the transmission ratepayers, as well as providing a congestion hedge from supply to load. And so, we want to stress that we don't think that one of these goals or one of these purposes has primacy, but rather that we need to find a balance in achieving both of these goals. Second, CRRs, despite underfunding, are actually working well for LSEs. We're not going to provide any specific data, but the consensus among the group is that the CRRs are functioning well. So given those 2 points, we think that we should really focus in on 3 goals for this initiative. Improve underfunding through incremental modeling enhancements. 2, evaluate the auction efficiency of unallocated transmission or unallocated CRRs. And 3, avoid solutions that create additional problems. So let's not go backwards. Let's continue to make progress. So I'll dive into each one of those points now. So next slide, please. So again, these are what we view to be the 2 main functions of CRRs, right? Returning congestion costs to load, to transmission ratepayers, and enabling a congestion hedge for load or participants. And it feels like at times stakeholders have focused in on one of those two or only one of those two perspectives or goals. And so we're not trying to say that one takes priority over another, but rather that when we're talking about this initiative and setting these goals, that we got to try to create a balance between those two purposes and not just hone in on one particular function of the CRRs. Next slide, please. So as I stated earlier, we think CRRs are doing pretty well despite underfunding, right? Data that we've looked into suggests that while it's not a perfect hedge, the CRRs are working well enough to provide a considerable hedge from congestion. There's still room for improvement, obviously, but let's build on those 2019 changes and continue to try to reduce underfunding and improve auction efficiency, but not revert back to methods that we know weren't working. We think specifically that the CAISO analysis lends itself to saying that that shift factor threshold modeling inaccuracies and unsettled flows could be two areas that we should focus in on. And so the goal that we'd throw out for consideration by stakeholders is to improve underfunding through incremental modeling enhancements and identify any changes needed to accommodate EDM market impacts. Are there any questions or raised hands or anything? I don't see any.
No questions.
Okay, great. Okay, well, and I'll keep rolling along. Next slide, please. So we think that another area that we should focus in on is to look at unallocated auction CRRs. So we believe that the data that has been shown shows that CRR auction is like the biggest problem that we need to solve. The most potential for returning additional dollars to transmission ratepayers, most room for improvement, if you will. And so that should be our top priority in the initiative. And specifically, a large volume of unallocated transmission capacity or unallocated CRRs, that is likely to be a source of auction inefficiency that we can fix. Right? If I want to sell a $10 asset to Partha for $1, that's me losing out. But if we have unallocated CRRs being auctioned off at a low auction efficiency that I'm not a party to, that those revenues can go back to ratepayers, that's a really a place where the market can benefit and not just trying to nitpick people's individual transactions. So for the group and stakeholders, we'd like to put forward these goals. Specifically, analyze the auction efficiency of unallocated transmission or unallocated CRRs and explore solutions that resolve this source of inefficiency while maintaining liquidity. Any concerns, questions on this one?
No questions.
Okay, let's keep moving along. Next slide, please. Okay, and then kind of our final point here is we want to try to avoid fixing something that's working well, right? Let's not create additional problems. We believe that track 1A and 1B improved revenue adequacy and auction efficiency. We think those changes should not be unwound without clear reasoning and quantified benefits, and that revenue adequacy and auction inefficiency should be distinguished and treated separately. So let's keep making progress. Let's not go backwards. Okay. Next slide, please. So again, these are our recommendations that we explore incremental changes to modeling and allocation that improve underfunding, that we explore what changes the auction of unallocated transmission could be made to materially reduce auction inefficiency, and the 2019 improvements are working and should be built upon. So that is all I've got, but I'm happy to take questions, hear any feedback.
Yep, we do have a hand up from Callie.
Hi, it's Callie Wells with WPTF. Can you hear me okay?
We can hear you.
Okay, great. Thank you so much for this presentation. I just had a couple questions for you, just so I can make sure I understand what you guys are thinking. When you say focus in on auction efficiency, do you guys have an idea for how you would measure that? Because I think part of one of my big takeaways from the CAISO's analysis on that specific metric was there are a lot of very, very valid reasons why we would never expect that to be 100% and why they're naturally going to be under that. And I think in my mind, at least, that kind of calls, I wonder if there's another way to measure that auction efficiency. So I was curious if you guys have any thoughts onto how you would go about measuring that.
So I can't speak for the group, but to that specific, but Todd Ryan, I mean, I don't have any specific suggestions for how we measure it or perform the data analysis, but specifically, I think what we're trying to, the group is trying to point out is that the unallocated transmission is an area where improvements will actually result in dollars being returned to ratepayers. It's not just a private bilateral transaction. So to the extent that we can narrow in on the unallocated transmission and understand how inefficient they are and or if there is an inefficiency there, can we improve it through some incremental changes or to the auction model? So we're not specifically advocating for one solution yet with the goal of creating goals for this initiative. We're putting forward that as an area that we should focus in on and try to address.
Okay, no, I appreciate that. And then the second question I had, I think on one of your last slides, you said to kind of separate out the underfunding and auction efficiency issues or concerns. I was curious what you guys' thoughts were, because when I think through ways to improve the underfunding, and I completely agree, I think improvements to the CRR model are much needed, and I think the analysis shows areas where we can focus in on improving that. What are your thoughts on if we make improvements like that, that will naturally not only address underfunding, but in my mind, it will also likely increase the auction efficiency metric that the CAISO continues to report on? Do you guys have, do you share a similar perspective, or is there another reason why you think it's, that we should think about them entirely separately?
So again, Todd Ryan, I think I understand your connection between the underfund, what you're saying about improving underfunding could result in improved inefficiency. I still think that they're, to the first order effects, pretty separable problems. But I'll let if there's more data or modeling that we can do to shed light on it. Obviously, any improvements we can make that affect both underfunding and inefficiency, great. But I don't want to necessarily rely on the hope that modeling improvements will translate into inefficiencies or gain efficiency.
Yeah, and I appreciate that. Maybe I wasn't quite clear. I agree how you characterize it at the end. Making modeling improvements will likely improve both of them. So when I think about some improvements we can make to the modeling as well as how the underfunding is allocated, I think those changes will also naturally improve the auction efficiency. So there's still kind of that second order effect. So I think it'll be important that as we kind of think through changes to recognize that hey, if we make modeling improvements, we'll likely see improvements in both of these metrics. So, okay, thank you so much. I appreciate the presentation.
Yeah, great, thanks.
Actually, is Kelly still on the line, by the way? If you're willing to raise your hand, Kelly, this is Partha. I had a follow-up question, one for Tom, but that's Kelly for yours too. And maybe it's just more for stakeholders who are new to this process, just to make sure that we're level setting on auction efficiency. So in general, I think when we talk about auction efficiency, it's more of a term to describe the differences between, what's been sort of incorporated in this proceeding is the differences between what is paid for CRRs versus what's ultimately sort of received via congestion revenues. And Callie, you indicated that we wouldn't expect these to reach 100%. And I was just wondering if you could maybe elaborate a little more on that. I could imagine a scenario for certain paths where there might be competition from multiple parties wanting to hedge a certain congestion risk, and that that in that case it could be that given there's a value to the hedging instrument, it could be driven up above 100%. I was wondering, Kelly, you made the statement of we would always expect it to be below. I was just wondering, Kelly, if you would be willing to maybe talk a little more about that and sort of how we should be sort of thinking about the whether or not certain paths should go to 100% or not, based on how transactions are done.
Yeah, of course. And I mean, I don't think it's necessarily whether or not certain paths should go to 100%. I was thinking more along the lines of Guillermo's presentation and analysis had a very, I thought, extremely useful and informative slide on all the different factors that go into the auction itself, and then how that flows into the auction efficiency metrics. And so a couple factors that I always think about that kind of explain why you would never expect it to be 100% is first, risk premium. You're bidding for these products a year in advance for some of them. Conditions are going to change. The model's not going to be accurate. So you're going to build in a risk when you submit your offer price to get a CRR. And that risk is going to obviously be lower than the expected value. The forward market versus spot market thing, and I think that kind of ties in with the first one, right? It's a year ahead product. Some of them are, your month ahead products, but you're bidding for a product in a forward market. So expecting that to equal the price based on spot market isn't really accurate. And then the other one is obviously conditions change. We all know that, and extreme events happen. And so when you get those extreme events happening that cause congestion to go through the roof, and you weren't expecting that, obviously, when you're bidding on these products, that can drastically change the auction efficiency metric and look like the revenues going back to the CRR holders are a lot higher than what they paid for. Well, they're unexpected conditions because they're unexpected. You can't predict them when you're bidding in the auction. So just kind of factors like that. And I think, there was the undervaluing or the arbitrage. I'm trying to think of that slide Guillermo had up, extremely informative, that had all those factors. So lots of reasons why you would never expect that auction efficiency metric based on how the DMM and the CAISO calculates it to be 100%. So hopefully that helps.
That does. And I was trying to make sure it's tying together with those other examples, because it's obviously, to me, different. I think you're talking about if it was being set by a risk-averse entity who was basically, it'd be different in terms of what that risk premium would look like if it was a number of entities who already have positions out there and were looking to hedge the risk of congestion on those paths. But if someone who does not hold a position and is taking a financial, you understand why it wouldn't necessarily clear at 100% based on those risk factors. So that's what I was trying to get at.
Yeah, I think it would be both. So anyone who's bidding in on a product and offering to buy it is going to build in a risk premium because you don't know what is actually going to materialize. So I see it for all participants bidding into the auction, they're going to build in a risk premium. Okay. And with the levels of underfunding we've seen, it's obviously a higher risk premium, which is dropping the offer prices theoretically.
Yeah. So you're saying even for example, like let's just say that you have an aggregator, someone who's creating a hedge, and they've sold some hedge right, you're saying even for those entities who might be wanting to use this as a part of a overall hedge strategy, they might also build in a risk premium based on the timing, even if they've sort of sold forward energy at a location or looking to hedge that, they'll still be sort of discounting the amount that they're bidding for the CR instruments?
I would expect so. I would expect that to be the case, but if there's other people, I don't personally, submit bids. So if there's somebody else who has closer experience with that, I'd, feel free to let them chime in. But yes, I would expect that to be the case.
Thanks, Kelly.
I'll just add that I think the DMM data show that there's some transactions in the market that are clearly within like a reasonable risk premium, and there are a large number of transactions that fall outside what most people would consider a reasonable risk premium. And so clearly there's areas that if we can find a way of parsing the data to understand what subset is causing those larger inefficiencies, that's where we want to target in. Our best guess at the moment is that it's from these unallocated CRRs.
This is Parthal Vadkar. Maybe while I'm asking questions, could we go back to slide number 2? Because I think this is really maybe, as we go into the problem statements, I think this is going to be a kind of a key element. So your bullet number 2, CRRs are working well as a hedge despite underfunding. We've heard from a number of parties, and we have analysis that talks sort of generically about what the underfunding looks like. A number of parties who are saying like, no, this is really a significant issue for the hedge value is built in. That there's a number of reasons, particularly some of them reference some of the 1B changes in terms of the targeted constraint allocation issues as sort of driving some of the underfunding. Todd, maybe just I was going to ask, any sort of thoughts, and it might be for you, it might be for other participants, on sort of why you all see them as working reasonably well as hedges while other people might not?
So I know I cannot speculate on that difference other than, obviously different participants have different positions. I'll just say again, anecdotally, for Pacific Gas and Electric and our groups here, a group of LSEs, is that we are finding that the hedges that the CRRs that we're nominated and allocated are doing a decent job at protecting us against the day-ahead congestion. So it could be just the fact that different participants are positioned differently. I don't want to speculate really at this moment, but I think it's important to understand that if you're balancing those two different needs between reimbursing ratepayers and providing a congestion hedge, that, for a majority of the LSEs within California, these are the ones represented here, we're saying it's doing a good job. So let's not go backwards. Obviously there's additional, probably other functions for CRRs, or other people are viewing them as a different type of product, but to us, those are the two key functions, and let's not keep them working well and just go for improvements.
Okay. We do have some questions and some hand raised, so we'll start with Abram.
Hey, Todd, it's Abram Klein with Appian Way Energy Partners. I just wanted to touch base on the two purposes you identified in terms of the second one being providing a congestion hedge from supply to load. What's your view on that purpose with respect to not just providing a hedge for LSEs to meet their load obligations, but also say you have merchant generators who use them to hedge their basis risk or renewable resources that might be doing that, or even market participants that are trading with both of those using them as hedges as well. You sort of said particularly for load as the purpose. It seemed to discount the FERC principles about providing congestion hedges to suppliers who are trying to compete in the market?
I don't think it was our intent to exclude merchant generators. I think I personally can still consider that as a, from supply to load, even if you're a merchant. So my apologies if it sounded like we were trying to leave you out or leave a particular participant out. I just wanted to distinguish that from like a purely speculative function.
Okay, thank you.
Awesome, thank you. We will go to Seth next.
Yeah, I just, getting back to some things that Callie was saying, I was also thinking myself that there's a time value of money component on all this. So in other words, entities are buying these and then they're insuring for some sort of forward payment, that comes when the auctions actually settle, when the auctions actually settle in the day-ahead market, when it positions. So keeping that in mind, the LSCs are actually getting their money up front as well for their, congestion exposure. So I'm wondering how the LSCs view that. That should be a benefit for them because they're effectively getting some of their auction revenues up to a year in advance than what they would if they just waited for the actual day-ahead rents to come in when those days in a particular month settled. So there should be a benefit there as well. And then that same benefit on the other side of the coin, you would see people paying much further in advance, so their bids may not would reflect the time value of money. So I think you have to incorporate that into your thinking of auction efficiency as well. And I'm curious how the LCs think of that as a benefit of having the auction revenues up front.
I can't comment for the LSE group, though I think by focusing in on unallocated transmission, that benefit wouldn't exist, right? Because those unallocated CRRs, while the revenue from the unallocated CRRs that are auctioned off do get returned to scheduling coordinators, pro rata by load, I believe. What we suspect is a large inefficiency associated with that. It means that those dollars are not getting actually returned at the rate it should be. So there is a big opportunity cost there for LSCs. Oh. I won't speak on specific ones that are auctioned and then, that are nominated, allocated, and then auctioned by LSCs specifically.
Okay, that's not quite my point. My point is that unallocated stuff goes to auction, and you get those auction revenues right away, whereas the congestion rents don't actually transpire until the actual flow date. The congestion rents don't accrue until the day of the day-ahead markets. You're actually getting your congestion rents way in advance. So the point is that a dollar today is worth more than a dollar tomorrow. So if you're getting all that in advance, then that should be of some benefit compared to waiting for it. So let's tease that. Let's say that. Okay, you understand? Okay.
But my point is that if we're only getting 1 cent on the dollar for those unallocated CRRs, then it doesn't matter if we get it a year in advance or 10 years in advance. We're not actually making the money. The ratepayers aren't getting the dollars they deserve.
Okay, so you're saying it would bridge some of the gap, maybe not all the gap.
Again, I think that we need to look at those data. To my knowledge, I've combed through all 1 million pages of Guillermo's presentations. Thank you, Guillermo. But I can't remember a chart that specifically broke out unallocated CRRs, and I think there might be some difficulty associated with doing that.
Okay. I'm just not sure you should ever expect it to be 1-for-1 if you're getting all that money in advance because of the time value of money. Yeah. Okay.
Understood. Yeah.
Seth, this is Partha from CAISO. I was wondering maybe if you would be willing to sort of maybe talk a little bit more about sort of how you think about that time value of money. I'm certainly, yeah, appreciate any expertise you had on sort of how you view the valuation from the trader side.
Yeah, I mean, basically, it's, you know, the weighted cost of capital is your discount rate. So if you have some money that you figure that you're going to make, that you expect on a particular COR out into the future, and you purchase it, you're also weighing into the fact that those payments on your COR way out into the future, so you discount those to a present value. So it's really just a matter of what you define your discount rate as. And of course, we're in a higher interest rate environment right now than what we were in 2018. So I would suspect that those payments would, you know, be discounted even more, which would factor into your present value evaluation of a COR. So it's something to consider. If you kind of view it in a vacuum, if you took on a COR and you thought that, and someone thought, well, this may just kind of break even, to them, just payment-wise, from the acquisition price to payout-wise, let's say, kind of thought, well, it might break even. But really, if you're buying that like a year in advance, you have to consider that you're actually acquiring it today, and you're not getting your payments for much later. So you're going to assess some sort of discount on your CR to account for that.
I mean, I don't think anyone's arguing about the concept that you're bringing up in terms of financial accounting or Econ 101. I think what we're just suggesting is that it doesn't account for the 50% underfunding, or sorry, 50% inefficiency.
I have a follow-up question. In terms of how your points here might map onto future process in the working group, is it a fair interpretation that it seems like on the first point there about, I'm sorry, I was thinking of the recommendation slide, your first point on the recommendation slide. So is it a fair characterization that that first point is more framed as we've seen enough analysis to give us a sense of where the issues are and what we need to explore, and maybe are ready to move into consideration of changes, versus your second point about efficiency? It sounds like you're saying there's an analysis stage here that we need to go through first around unallocated CRRs.
Can you go to the last slide? I believe it's slide 7. There you go. This is what, Hillary, you're referring to.
Yes.
Again, I think what we're trying to represent here is not jumping to solutions. It's to focus in on what this initiative's scope and goals should be. You know, and so to that extent, I don't think that we're representing an exhaustive set of modeling that we should consider in terms of the nomination and allocation process. Obviously, we have a lot of smart people working on it. There's a lot of smart people, stakeholders working on it. I'm sure we all have our different opinions on where we can make tweaks. So what we intended here is to focus in on, you know, the scope and goals of the initiative. So to that extent, we don't think we should be looking at like a complete carte blanche of the redesign of the nomination and allocation process, but let's do some targeted improvements that we can agree should provide improvements. And then in terms of the auction efficiency, we think we should focus in on what we believe to be the main culprit of the inefficiency, or at least the factor that could deliver most value to ratepayers through return dollars to ratepayers. So being the unallocated transmission, how that is being handled in the auction process. So we've specifically wrote what we should in for each slide of the goals. You know, hopefully that's something CAISO can copy and paste as a starter for goals for this initiative. And if stakeholders have any feedback on those, we're welcome to, you know, provide that, and I'm open to listening to it and working with everyone on this. Appreciate your time and attention.
Great, thank you. We do have another hand raised by Noah.
Hi, I just wanted to say, thanks for your presentation, and I think that we are in agreement, and I'm also speaking on behalf of ETI, in agreement that, we should look at targeted positive changes. One thing I just would urge you to look at is when PJM had pretty significant underfunding, it definitely drastically decreased the dollars going back to load because of the premiums. So I think, to your point about making incremental changes to modeling and how the allocation is that would improve underfunding, I think is really important. We have members that both are just speculative traders and ones that are actually hedging assets and hedging investments in physical assets. And the number one complaint that I get from folks is some of these hedges actually going negative on them because of the allocation process. I also just had one last question. I know one thing that was not really a priority at the beginning of this initiative that I think has, come to light as a bigger priority is the loop flow issue causing underfunding. And I was wondering if you had a view on that.
Yes, and I believe I know I can speak for PG&E to say that we want to look deeply into loop flow and how we can potentially make modeling improvements to that. But yes, I take your point well about PJM's underfunding issue. And, again, this is just an opening dialogue. So really appreciate everyone's feedback and would appreciate any feedback you have on the goals.
Thank you very much. We appreciate your time as well and your effort in this presentation. It was great. Thank you.
Okay, we do have another hand raised from Abram.
Hey, Todd, a couple questions. One following up on Noham's point about the loop flows. One of the concerns that's been raised in the EDAM filing is whether the recent reforms in EDAM are prioritizing non-Cal ISO firm rights over Cal ISO firm rights, and whether this would potentially lead to more underfunding and actually worsen that. And I'm wondering if that is something that you think is addressable in this group or something that your group is concerned about. And my second question, and by the way, I agree with you about there is some risk premium, but it doesn't account for, like, when you have a price spike in the Pacific Northwest and prices spike to $1,000 that nobody predicted for sure. That is a source of what you and the California ISO define as auction inefficiency. But I also think that is where, market participants that buy those are using them for hedges potentially. But my second question is, how would you identify the unallocated transmission and distinguish it from, say, the reconfiguration that's naturally occurring in the CRR auctions? So, like, an LSE might have allocated CRRs and actually choose to convert them into a different set of CRRs or choose to sell them. But when the LSE releases that capacity in the auction, another entity doesn't have to buy the exact same path. They're actually able to get paths for CRRs that meet their own business needs or hit their own, say, asset and address the congestion that impacts that particular asset or financial position, as opposed to it all going back. So there's certainly some unallocated transmission that is in the market and is sold for the market clearing price, but there's a lot of capacity that's released by LSEs that is converted into different paths. I don't know that Guillermo would be able to distinguish and identify what you're addressing here.
Yeah, thank you, Abram. I'll take those in reverse order. I'll just say, first and foremost, yeah, I don't claim to have the answer in terms of how Guillermo can parse the data to really hone in on the unallocated CRRs or unallocated transmission. Obviously, I'd love to dig into that further and try to figure out how we can, or at least approximate it. You know, we can answer difficult questions. Like, we have the capability, but we're not going to answer them unless we really push to focus in on them. So that's what we're trying to do here today, is just identify an area that we think needs more attention. So, you know, open to ideas, brainstorming on how we can even approximate that set of CRRs. And to your first question about the congestion rent allocation, I'll just direct everyone to our comments in that initiative. I don't think we should merge them together, this initiative and that initiative at the moment, but I do understand your concern and do share your concerns there. Partha, please.
Yeah, this is Partha Malvacker from the ISO. Just to follow up on your one question, we are going to have some time later where we're discussing next steps on the analysis, including possibly some additional analysis on some of the impacts or some of the ways we could look at what is now was being coined as auction efficiency as a part of this initiative, and as well as how we might look at some of the requests associated with what the potential impacts could be of a willing buyer and seller framework and the timing of those requests as well. So we'll have some time, I believe, after lunch to have that conversation. So yeah, thanks for that question. Appreciate it.
Okay, one last hand raised from Mohammed.
Hi, Todd. This is Mohammed Bakar with AppNY. Thank you for the presentation. I'm kind of surprised that you're saying that you believe that the hedges are working well for the LSC, considering how we're seeing the majority of underfunding is basically between 30 and 40%, which leads me to ask, like, let's say the underfunding does go to 100%. What will happen? Is that cost simply passed on to the load? Or is there a recoup mechanism? Because when we are looking at underfunding, we're basically looking at missing congestion rent that did not make it into the market. So there are winners and losers here. And when we are talking about 40 to 50% underfunding, we have to look at, well, who's not paying? And like, from the LSC perspective, it's okay to just pass this cost on to load instead of recoup it from the people who should be paying for it?
Thank you, Mohammed. I don't mean to trivialize the amount of dollars that are, missing to ratepayers. It's not that we don't believe it's a issue worth addressing. We absolutely do. We have been pushing hard in this initiative as well as outside of this initiative to try to continue to make the improvements to return dollars to ratepayers. What we're trying to say is that we do believe that there was significant improvements made in the 1B and 1A tracks in 2019, and that while it's not a perfect hedge, we all feel that the hedges, the CRRs as a hedging mechanism have been working well. Not perfect, but well. And so, yes, absolutely, let's make improvements and let's return more dollars to ratepayers. So I love your enthusiasm and appreciate your concern. And so, again, we're not trying to trivialize it at all.
Just to follow up, is this working well simply because of the size of the LSCs? So if we look at, for example, a generator, a third-party generator, who's just one generator that's a limited megawatt hours per year, it's obviously much, much smaller than load. Wouldn't you think that the impact of 50% underfunding is much bigger on them than the LSCs?
Again, I can only speak for ourselves and what the group is telling me. So I can't speak to any other participant's position or anything like that. Again, we're not trying to trivialize the problem. There's lots of dollars on the line here, and I think that's reflected in how passionate people are, stakeholders are, and how consistently people are showing up to participate in this initiative, the fact that it was ranked high in the initiative catalog process last year. So absolutely, this is not a trivial thing. We're just suggesting that specifically on the auction mechanism, we think that there's been improvements and we should continue moving in that direction to further improve it and not revert back.
Thank you.
Yeah, thank you.
No other questions at this time.
Thank you again, everyone. Really appreciate your time and attention.
Thank you, Todd. We are ready at this point to move on to our second presentation. Casey Kahn of Sidley Austin on behalf of ETI. Casey, are you ready?
Hi, can you hear me?
Can't hear you on home. Yes, loud and clear.
Okay, great. Thank you so much. I had to hit the unmute button. Thank you all for your time today. My name is Casey Kahn. I'm counsel at Sidley Austin, and today I'm going to talk about the legal foundation that underlies congestion revenue rights, and then, you know, analogous, of course, to CRRs are financial transmission rights as well. Put them all in the broad bucket of these transmission-related instruments used to hedge congestion. You can go to the next slide. Thank you. Okay, so this all goes back to the 1990s. And so as FERC regulation and precedent demonstrates, CRRs and FTRs are integral to the open access transmission principles that are set forth by not just regulation, but also federal statute, okay? So originating from the the transmission open access principles established by the Energy Policy Act of '92, and later with the famous FERC Order 8088, the Commission has viewed price signals as essential to promoting the efficient use of investment in generation, transmission, and consumption of electric energy, okay? More specifically, Order 888 called for the ISO RTO markets to develop pricing methods for addressing network congestion, okay? Next slide. Okay, under the old pricing model, prior to Order 888 and to where we have come to today, under the old pricing model, it utilized a contract path transmission-based rights, allowing for the purchase of sale of congestion-free supply from a given source to sink, but rather congestion does arise actually with binding constraints from time to time due to power flows on the transmission system, okay? The concept of the reality of binding constraints was not represented under the old contract path paradigm, okay? With Order 888, the Commission recognized that there was a fallacy with this contract path pricing and explained that we need a new pricing model in order to give greater flexibility and bring about a flow-based pricing system to establish a price based on costs of the various parallel paths that actually are used when power flows. Oh. Okay, next. All right, so now we're getting, moving on in history and coming closer to today, but, then we had Order 2000, and there FERC recognized the need for a workable market approach to establish clear and tradable rights for transmission usage and promote efficient regional dispatch and support the emergence of secondary markets for transmission rights, and provide market participants with the opportunity to hedge the locational price differences, okay? And that's what leads to what we all know now, the LMP, locational pricing, marginal pricing model, okay? and that was developed to correct for the contract path fallacy and more accurately assess marginal cost of meeting demand at the point where load withdraws power from the sink, okay? And points that suppliers and generators inject at the source, okay? And this is the LMP model that we all recognize today. Accordingly, LMP pricing provided a methodology to ensure the least cost dispatch for efficient usage of the transmission system with instruments like CRRs and FTRs as the design element for market participants and competitors to be able to hedge the congestion that comes across a constraint. Okay, we can go next. Okay, so moving further, you know, we have now FERC precedent and even federal court precedent that with respect to CRRs and FTRs are these types of instruments, okay? In 2006, the Commission affirmed transmission open access principles, LMP pricing, and the capability to hedge congestion with FTR markets when they set forth Order 681 in response to the statutory obligations of the Energy Policy Act of 2005, okay? The Commission addressed the need to hedge long-term firm transmission rights, ordered that ISOs and RTOs develop FTR tenors that are greater or 1 year or greater so that people can have the capability to engage in long-term transmission hedging, and also to allow for the statutory objectives of EPAC 2005 to promote long-term transmission open access. Here, the Commission clearly recognized that the function of FTRs are to serve as a hedge, particularly for congestion, and whoever is dealing with that congestion, okay? In 2017, in the PJM context, FERC affirmed that FTRs serve to provide a congestion hedging function. And they say, I quote, "We reject the arguments that the sole purpose of FTRs is to return congestion revenue to load, and that the market should therefore be redesigned to accomplish that directive. FTRs were designed to serve as the financial equivalent of firm transmission service and play a key role in ensuring open access to the transmission system by providing a congestion hedging function." Now, it's also notable that with this case, that there were petitions to overturn FERC's holding here, and the DC Circuit denied those petitions and deferred to FERC's order. Okay. Hold on. You can go to the next slide. Yes. Okay, in 2022, FERC reiterated, consistent with Commission precedent, they said that they reiterate, the purpose of FTRs is to serve as a congestion hedge, has been well established, and FTRs were designed to serve as the financial equivalent of firm transmission service and play a key role in ensuring open access to the service by providing the congestion hedging function. Now, these precedents and this particular precedent, they have economic foundation. They're grounded in reports like by the Independent Analysis of London Economics International, and in both the PJM and MISO contexts, they have found that the liquidity provided by financial market participants in the FTRs has been able to help shore up the FTRs and save consumers by enhancing liquidity and transparency and hedging of the forward market, basically bringing about prices in the forward curve or approaching efficiency and bringing about a clearer forward curve for market participants to be able to invest in projects and what have you. Okay. And, you know, one more thing on this point, as recognized by LEI and as recognized generally with respect to derivatives markets that have been designed to hedge physical realities like energy and transmission, or it be it crude oil or other commodity, underlying commodities, these markets rely on the hedgers who have the physical interest in the instruments, but they also rely on other market participants, financial market participants, being able to provide that liquidity, and that it is very important for both multiple market participants to be able to be engaged in that process. Okay, we can go to the next. Okay, with respect to FTR and CRR underfunding, FERC precedent recognizes that underfunding is a severe problem and clearly supports allocation of costs based on cost causation principles. The FERC precedent is clear regarding cost allocation. Assign costs specifically when specific beneficiaries can be identified, and assign costs broadly when it's not possible to do so. As FERC has recognized, underfunding harms CRR holders and harms transmission customers by devaluing congestion rights, or FTRs, that are allocated to them. In the PJM context, FERC directed PJM to resolve their underfunding problems, finding that underfunding devaluated their instrument of the ARRs and resulted in discounted value for the transmission network. And in that proceeding, FERC ordered PJM to allocate balancing congestion costs to real-time load and exports rather than to FTR holders, as FTR holders were not causing such costs to be incurred. FERC found that PJM's previous allocation, cost allocations, were unjust and unreasonable and violated the cost causation principle. Okay. And then we can move to the last slide. Okay, in summary, the CRRs and FTR instruments, they are crucial to the open access reforms as set forth by federal statute, long-standing FERC regulatory precedent, even as held by the federal courts. As FERC has consistently reiterated, CRRs and FTRs serve as instruments for suppliers, generators, and market participants to provide the financial equivalent of transmission service and hedge against the potential congestion risks that could arise from that service. Congress went back, they looked at the whole market design construct, which included the concept of CRR and FTR instruments in EPAC 05, and we don't see any kind of statutory change in the offing that would undo the open access principles that were set forth in the 1990s and, you know, held through to today. And we don't see that there is any kind of regulatory overhaul with respect in the offing with respect to open access principles. Lastly, any attempts to redesign these instruments, CRRs and FTRs, to bring about the older contract path model and one-dimensionally seek to return congestion to load, they would be contrary to the federal statute and long-standing FERC precedent. And I'll pause there and see if there are any questions or comments.
Thank you. We do have a hand raised from Noha.
Sure.
Hi, Casey. I just had one quick question. I know that, you know, we've had a couple of conversations about the precedent here, and Kaito has been kind enough to share some of it in the process as well. And I just wanted to know, like, what are your thoughts? Obviously, FERC has changed its mind in the past. What are your thoughts on, you know, a paradigm shift here? How likely is that coming out of the commission?
With the the present makeup of the commission and the new administration change, and even in prior administrations, we don't see that there is any such sea change that the commission is looking to do with respect to these instruments, and again, with respect to the open access principles that are longstanding at this point. And these open access principles, again, are statutorily founded, from the organic statute of the Federal Power Act and all the amendments thereto. We don't see that there's any kind of material change to undo open access principles. And then, of course, derivative to those open access principles are these FTR and CRR instruments. We don't see that there could be a sea change as of right now.
Thank you for that.
No other questions.
Okay, thank you for your time.
Oh, sorry, go ahead, Partha.
Sure. This is Partha Malbacker with the ISO. Yeah, Casey, really appreciate your presentation, and I recognize David Zlotlo from our legal team is also on here. And obviously there's a number of different precedents across the country in terms of the roles of financial transmission rights in organized markets, and FERC precedents as well. There's some of the rulemaking proceedings that have been applied more broadly. So yeah, appreciate your sharing this, your perspective on this. I particularly was wondering if you could go into maybe a little more of a follow-up on Noha's question on sort of the paradigm shift and some of the FERC precedent, recognizing the fact that we sort of maintain, at least from the CAISO's perspective, sort of the need to facilitate open access, facilitate congestion hedging. But I was wondering if you were willing to sort of expand a little bit more about on your last comment on sort of the current commission and your thoughts on the precedent. Noah's question was, I think, a little broad in terms of what a sea change paradigm would be. But yeah, I was wondering if you could talk maybe just a little more about sort of what might be in your mind sort of permissible and not in terms of sort of how you've seen the case precedent in particular in PJM and other places play out.
So insofar as there's any kinds of initiatives that are, so we had in the PJM context with the independent market monitor over the last few years, making the argument that, now their argument is a strong argument that the purpose of the FTRs is to serve as a congestion head. Forgive me, that's not. The purpose of the FTRs is to return congestion revenue to the load, okay? And their argument, as the commission has said, is that the sole purpose of the FTRs is to return congestion to load. So congestion revenue to load, sorry. And so any kind of arguments like that, where it's a strong foundation that this is the whole purpose of the FTR, as opposed to the purpose of the FTR is really just a financial hedging function to be the financial equivalent of firm transmission, that's where we do not see that there would be a sea change or a shift away from that view.
No, that's really helpful. Yeah, appreciate that addition.
We do have another hand raised by Abram.
Sure.
Hey, Partha, I just wanted to follow up on your comment there, or the question. So I do think there's an interesting dynamic in terms of, obviously, I think we all agree that the congestion hedging function is important. And there's a balance between returning congestion to load and doing that. So in the case that Guillermo went through an example of the January storm, where say market participants were wheeling power through California up to the Pacific Northwest to meet their load obligations up there. I think that would be deemed in terms of California's analysis as a huge source of auction inefficiency, right? There's this, you know, Guillermo went through the prices of those contracts were less than $1, and the actual spot prices were $1,000 during that period. So exactly the kind of concern that has been raised about auction inefficiency and ratepayers being harmed or losing out on those. But I do think that FERC would view that in terms of wheeling power up to the Pacific Northwest, as that is a core function of the CRRs in terms of facilitating competition for transmission and getting power to move around the system in the context of having an ISO or RTO. And so it really hits at, I think, the crux of the issue about how the auction efficiency can't necessarily predict all of these unusual events. And when you look back over the course of the year, you're going to find some. Anyway, I just wanted to point out that this whole precedent about the FTRs being made available or CRRs being made available to market participants to be able to hedge what's going on in the market is really a crucial aspect of this. And it relates exactly to the issue of the auction inefficiency, where FERC would view that as probably needing to make those kind of contracts available for market participants to hedge, but it inherently will lead to auction inefficiency. And to me, it goes to the very crux of the issue here.
Thanks for that, Abram. And maybe I can, one follow-up question. And maybe just to maybe set the context for some of my questions. So in the second half of this today's meeting, we're going to be discussing a little more about the problem statements and the goals. And I think that part of what we're doing is we're trying to understand the different stakeholder perspectives. We're also trying to understand what the FERC precedent looks like in the various cases as well. So I think that, at least in terms of grounding ourselves in sort of a common understanding about the problem statements, is also maybe grounding ourselves in a common understanding about how FERC has ruled in different cases, and what are sort of the potential parameters in terms of how we would define those problem statements, how we look at solutions in light of those. And obviously there's some stuff that's grounded in statute. There's some stuff that's grounded in different case precedent, and we might want to think about those differently in terms of moving forward. So Abram, at least in terms of your last question, I'd love to hear more about just the sort of inherent tension with respect to sort of that open access principle. And so can you maybe expand a little bit more about sort of why you think kind of inherently those rights would, we recognize the fact that for some of them there's a significant amount of volatility, so they can, stuff that we're expecting to have a flow position could have a counterflow position in terms of the settlement at the end. But can you just talk a little bit about why you think sort of inherently those would be sort of traded at sort of below 100%? 100% might be the wrong term.
Oh, I'm not saying that they would be underfunded necessarily. I'm saying that the auction inefficiency metric is very extreme, as Guillermo showed, when you have a price spike in one part of the system that wasn't predictable in advance. But market participants who are, let's say you're a solar developer in Southern California that is contracted to up to the Pacific Northwest, or a merchant power marketer who's trying to meet load obligations in the Pacific Northwest during those circumstances, and you might buy CRRs to be able to hedge against the transmission volatility there. Did you follow?
I do. I was just, it's probably more trying to understand of, I recognize the fact that there's volatility, so there might be some, unanticipated event that could cause a extreme change in terms of congestion patterns that wasn't anticipated in the CRR process. I would imagine in general that that would go both directions, where there might be some parties that would be, and I think that that's obviously what you'd see in those events, is that some parties are affected, some parties lose money and some parties make money, depending on if they have, a flow or counterflow position over the binding constraint. So just wanted to maybe elaborate more on that.
Yeah, if you're asking my opinion, I think what FERC is saying is that the transmission has to be made available under Order 888 open access principles. It's allocated to load serving entities in the form of ARRs that can be converted to CRRs, or could be converted into different CRRs. And then there is a market mechanism for offering the remaining transmission capacity and allowing for reconfiguration of paths, so that entities that are trying to hedge, if they have specific generator resources in a specific location, can get the hedges that they need, and everybody can participate in a competitive auction and get the competitive transmission basis positions that meet their own business needs. And I think FERC is completely indifferent as to whether there are, if that, they care about whether that market is efficient in terms of the real meaning of the word efficient, but they don't care if, once the allocated CRRs, if they're sold, if that was a good deal or not a good deal, or if there was additional transfer capability that was released and market participants found that there was congestion there, and that resulted in, profits for entities that bought those CRRs. But that's my view. I think that's, people may have a different perspective on it.
No, thank you for that clarification. I understand. Yeah.
There's actually a long affidavit by Roy Shanker in the PJM filing, which really goes into the whole history and the detail about, what FERC was thinking at the time in terms of the products. A lot of people know Roy, and he's been around for a long time in these markets, and it was a very good kind of summary of the original precedents that goes more into detail than the slides Casey presented.
That's right.
No other hand raised or questions in the chat right now.
Okay, thank you.
Thank you, Casey. We are now ready to move on to our next presentation. Sophie Jobs of Nodal Exchange. Are you here with us?
Yes, I am. Can you hear me?
All right. Floor is yours.
Thank you.
Again.
All right. Hi, everyone. I am Sylvie Jobs with Nodal Exchange. I appreciate the opportunity to speak today. Since we're not traditional CAISO stakeholders, I'll start with a little background. If you can please go to the next slide. So Nodal Exchange is a commodities exchange. We represent 56% of market share of the U.S. power futures open interest as of the end of 2024, and 93% of market share of non-hub trading volume in that year. As of the end of Q1, that market share is up to 57% of open interest, and we were 96% of non-hub trading in Q1. So that being said, we offer power, natural gas, and environmental contracts. Our power contracts are options and futures covering the 7 organized markets, as well as a Mid-Columbia contract. And we have multiple trading platforms. You can trade on the screen or block trades submitted by brokers. All of our trades are cleared through Nodal Clear. Nodal Clear also provides clearing services for Coinbase Derivatives Exchange. And we are part of the EEX group, which is then in turn part of the Deutsche Börse group. So that's a little bit about Nodal, but in this context, it's important to note our ties to the CRR markets and other similar markets to it across the ISOs and RTOs. I'll collectively refer to those here as FTRs if I'm talking about the sort of market as a whole. But to sort of get to those ties, we have significant participant overlap in these auctions compared to the participants that are part of Nodal Exchange. Nodal Exchange also offers day-ahead congestion and energy contracts, which are economically equivalent to CRRs when they're traded as a spread. And we even have historically offered auctions that are very similar to the financial network model that has been proposed in the DMM's willing seller design. So although we are not CAISO participants, we have a vested interest in the CRR Enhancements working group because we believe the liquidity generated in these auctions benefits price discovery and liquidity beyond just the ISO RTO markets, which then reduces uncertainty and hedging costs across the industry. This presentation I'm giving should be pretty brief. It's similar to the comments that we submitted in December, but my hope is that emphasizing some of our key points may provide a useful, different perspective for the working group to consider. Next slide, please. So the FTR market as a whole has been growing like crazy. On the left here, we have a chart showing FTR market volume in red, which is broken down by region on the right, and exchange volume in blue. The FTR volume is actually displayed on the path level. So if we showed it in terms of outright volume, which is how the exchange volume is measured, it would actually be twice what you're seeing here. In other words, the FTR markets dwarf the exchange market. There's so much trading happening in these markets, and this is something we're happy to see because the two are intimately linked. The FTR market, CRR market, is a critical source of price discovery and hedging activity that drive activity in the exchange markets. In fact, if you go to the next slide, you will see some analysis that we performed on Nodal Exchange spread futures trading, which found that there's a significant bump in exchange trading following FTR auctions in MISO and PJM. The daily average MISO spread exchange volume in the week following FTR auction results being published is 70% higher than average on other trading days. And for PJM, that's 87% higher. This analysis was in support of London Economics International's evaluation of PJM and MISO FTR markets, which I have linked at the bottom of this slide because both of those papers provide more details on this specific topic, as well as many other interesting insights, which are worth reviewing if you haven't already. Looking at the next slide, here we have a view of growth in energy for load, which is dark blue, FTR path volume, light blue, and exchange basis volume in green from 2021 to 2024 in PJM and CAISO. We included load here to show that demand is not a significant driver. And we did look at the most recent data, but these patterns are consistent even if you look at other years. We don't think it's a coincidence that PJM has the largest FTR market and the largest exchange market. The growth in PJM FTR market volume corresponds to growth in exchange basis trading. This creates opportunities for both lower cost hedging and more granular risk management. We've heard a misconception perhaps that people think exchanges might be happy if FTR or CRR markets were to disappear because the volume would shift over to us, but that doesn't appear to be the case. As you see here, as CRR volumes have fallen in CAISO, the exchange basis volumes have shrunk even more. On the next slide, please. Next slide. Thank you. So all of that is to say, we strongly encourage CAISO and all ISO RTOs to support robust FTR markets, CRR markets in the case of CAISO. The physical network model that's currently in place for clearing CRR auctions is uniquely capable of creating the liquidity that I've been talking about. Shifting to a financial network or bilateral model threatens to reduce that liquidity, not only in CRRs, but also in exchange markets, which would lead to suboptimal risk management and at a higher cost. The third bullet here is a bit of a tangent from everything else I've been saying, but since there is discussion of what we've heard referred to as auction losses or auction inefficiency, I just wanted to touch on it briefly from an exchange perspective. We see this amount by which the CRR payouts exceed auction revenues as the hedge premium or the risk premium that some people have been discussing this morning. What the buyer of the CRR receives for taking the risk of the unknown outcome of the day-ahead market. To the extent that this premium is unpalatable or consistently skewed in one direction, it may make sense to explore model improvements. For example, are there differences in the FTR and day-ahead model designs causing this outcome? But the existence of this premium is not inherently bad. As London Economics identified in their PJM evaluation, it may make sense to weigh the size of this premium against the benefits that it allows to determine whether it's reasonable. We really appreciate that the ISO is exploring enhancements to the CRR auctions. Our main ask is that CAISO consider other solutions that could achieve greater auction revenue for ratepayers at a lower cost for hedging, rather than making drastic changes to the CRR auction design that could put liquidity at risk. I did link our full comment letter here if you're interested in reviewing that, and I believe there's a little time remaining if anyone has questions, but I've also provided my contact info on the next slide for anyone who's interested in further discussion. Thank you again for your time.
Okay, I'm not seeing any questions and no hands raised. So I think right now we're going to take just a 5-minute break. So stretch your legs and we can meet back here at, I'm sorry.
Do we have a raised hand from Doug Bacignani?
Oh, sorry. Thank you for that. Sorry, Doug. Yes, go ahead. Doug, if you're speaking, oh yeah, sorry.
So I didn't realize I needed to unmute myself. Apologies. Yeah, this is Doug Bacignani from Flynn Resource Consultants for the Bay Area Municipal Transmission Group. Thanks for this presentation. I had a question. You showed with the slide that had the blue and green bars, the growth for PJM and CAISO. I'm curious, can you give us a sense of the relative volume for PJM versus CAISO? Not, this is showing the change in volume, I guess, but what's the starting point?
That's also part of why we included the load, just to sort of, oh, well, yeah, the growth doesn't help with that. So that's a good question. The volumes we're looking at for CAISO, this is in megawatt hours in 2021, or I guess terawatt hours would be easier to say here. In CAISO, it was about 250 terawatt hours, and in PJM, it's 8,112. And then in 2021, CAISO had gone down to 240, and PJM increased to 10,732.
And I mean, that's the energy volume for the load, but what about the exchange volume?
Oh, I'm sorry, that was the FTR and CRR volume. The exchange volume that I'm looking at here is I'm sorry, pulling this up for ISO. Looking at the basis volume, we're looking at about 96.6 terawatt hours, and PJM, sorry, that's in 2021, going down to 86.1 in 2024, and PJM is going from 1,455 to 1,918.
Great, thank you. And the first year you were saying, which year was that?
2021.
21, and the next year was
24.
24. Okay, great. Thank you very much.
No problem. Thank you.
Okay, we do have another hand raised from Jonathan.
Hi, Sylvie. Thank you very much for your presentation. This is Jonathan Rumble from Southern California, Edison. Can you go back one slide, please? Can we go back one slide? There we go. I just have a question about when in your bullet, your sub-bullet, your sub-bullet, and the third main bullet, as London Economics identified in its evaluation of the PGM market, benefits resulting from the hedge premium should be weighed to determine whether it's reasonable. The idea of it being reasonable, what is your intention of defining reasonable?
I guess thank you for that question. I think it's just sort of looking at a cost benefit analysis is what I'm referring to, and what's done in the London Economics evaluation. They look at that, overall number that is that I'm calling the hedge premium, and compare it to the various benefits that are derived from it. This is in section 6.13, I believe, of the PJM evaluation, where they evaluate whether the benefits outweigh the costs.
And I guess where where the rubber hits the road here, or the rub is that yeah, there should be necessarily a hedging premium, but can we really identify where there is efficient, I guess, price discovery so that the hedging premium is reasonable? And if there's not enough participants in a market, that it is illiquid, and certain participants who are there can sort of extract excess rents out of the market. And I think that's one of the things we struggle with, is how to sort of walk that fine line. Sure, we understand the idea of a hedging premium, but when is there just speculation? And that's not really what the intent of this market is.
Sure. Yeah, I'm not sure if there's a question there. I think there's
Well, I mean,
certainly...
it just goes back to what is reasonable, and I think simply just a cost benefit analysis is, it's like, well, I think we need more than that to sort of be convinced that all hedging premiums are efficient or good, reasonable.
Sure, yeah. And I think I mentioned this a little bit earlier, like I don't claim to be a CAISO specialist, but to the extent that these premiums are seeming excessive or they seem to skew like consistently in one direction, maybe there's some modeling changes that could be considered. And I think that's been the focus of various other stakeholders' presentations. And I would encourage that. I think that would be a good thing if it can allow the CRR market to continue providing the value that it does.
And I guess just to follow on, if PJM and some of these other markets are trading a lot more, obviously they're bigger, but just in general, but that also implies that there's more of this liquidity and probably more participants. Is there anything sort of structural that you see about the CAISO market that you know, is not helping to attract sufficient participants to have the, you know, necessary liquidity for more efficient, you know, price discovery?
Something specific about the CAISO market that is preventing the liquidity for sufficient price discovery? Was that your?
Yeah, I'm just curious if you think, you know, you're sort of comparing CAISO to other markets, and I'm wondering, in other markets, are they doing something differently that is allowing more efficient price discovery by attracting, you know, more participants?
Yeah, again, I'm not a CAISO expert. I think that would be something that would be worth considering if there's analysis underway. And perhaps some others in this group might be able to comment on that more effectively than I can.
Okay, thanks.
Thank you.
We do have a hand raised from Abram.
Hi, yeah, I'd love to continue the conversation a little bit because I think that Jonathan raises some really interesting points. And one of the issues here is distinguishing what's happening ex ante from ex post. So in my presentation in the January meeting, I went through the NP-SP spreads, which are fairly liquid and traded. And if you looked at the NP-SP spreads, you know, or prices at the time the auction was run in, say, November of 2021, NP was probably $75 round the clock for the year, and SP was $76, or it might have been vice versa, but there was a $1 spread there. And once you accounted for it, and it was actually a very efficient match between what the future spreads were and what the auction spreads were. But over the course of the year, as we know, 2022 had a big increase in gas prices and other fundamental factors. When we actually got to see the settled prices at the end of the year, the NP cleared at 100, up from 76, and the SP cleared at 95, up from 75. So that $1 spread moved to a $5 spread, which if you looked at, well, that's a 500% return, and that's kind of clearly not, if you think about it from a utility rate of return perspective, it seems like that's an unreasonable premium. But that, you know, 75 or 76 going up to 195 in terms of the prices, I think that's why the bullet here in Sylvie's presentation talks about how it's not uncommon for the spread premiums to be a much higher percentage of the notional value, and you get these kind of things. So that's not an auction inefficiency. That's just that the ex ante realization of the prices turned out to be different. I do think we see the California market as being very competitive, just like a lot of the other markets in terms of attracting participation. And this difference between ex ante and ex post is not a reason for you know, that the market isn't, it's not that the market isn't competitive, it's this difference between ex ante and ex post, which commodity markets are volatile, and these prices move around a fair amount. The one thing that California has that is different from other markets that might reduce competition is the level of underfunding. And that extreme level of underfunding, we've seen evidence from some of the comments, has driven out some of the physical market participants. Guillermo identified increasing sales from LSEs into the market. So when that is happening, it may actually bias the market more towards speculative traders who will just add more of a premium and discount the price that they're willing to pay for CRRs because there's so much uncertainty about what they're worth. So to the extent California does have an element in terms of the policy that's, driving more speculation and less physical hedging, it's probably the degree of underfunding. But overall, historically, I think we've seen a fair amount of competition in all of these markets when there's open access.
Abraham, you indicate that, in certain cases, there's sufficient competition, but it, just from the Guillermo's presentations, there still appears to be a lot of, near zero price auction sales, which doesn't lead me to believe that the depth of competition is really that great.
Well, you're looking against ex ante at what specific CRRs were profitable. You could have a zero premium with a lot of congestion in both directions, and they're offsetting. And you can also have zero premium just because people don't expect there to be congestion. People don't know in advance where the specific congestion might be, so they might be trying to capture a number of different constraints that would offset their specific basis risk. I don't think it's a lack of competition in the market that leads people to be able to buy zero priced FTRs, because it is a competitive process or close to zero price. It's the fact that people didn't expect congestion to occur on those paths, and there was some degree of option value that occurred there and was realized. But so the issue with low priced or zero priced CRRs is it's pretty complicated, and you have to look at the specific circumstances, in terms of where. And again, I don't know that there was a big part of his analysis that was looking at, I have to remember back the zero price, but that's a good question there to revisit.
Thank you. We do have another hand raised from Noha.
I was actually just going to follow up right before Abram, but Jonathan, thanks for your question. I just wanted to, one thing, and I'm also not a CAISO expert. I don't personally trade CAISO, but I think one thing that if you were looking at more auction efficiency, I think the underfunding issue is probably number one. But the other thing that may be helpful for CAISO to look at is, PJM has balance of planning, like more frequent auctions might be beneficial, and releasing that capacity with more information and getting better pricing. So just a tidbit for folks to consider. Thank you.
Okay, no other questions that I'm seeing. So we'll go ahead and take a 5-minute break, and we'll be back here at 11:05. Thank you.
All right, welcome back, everybody. Our next presentation will be from Roger Avalos of the Department of Market Monitoring. Roger, are you ready to go?
Can you hear me okay?
We can. Loud and clear.
Thanks. So I'm Roger Avalos. I'm in the power market monitoring, and we're going to present on basically what the fundamental flaws are in the auction design. So go to the next slide. So there's really two core design flaws. They exist in all FTR type auctions. The second one, to more or less degrees, depending on which RTO you're looking at. But the first one, as far as I know, is in all of them. And that is that the ISO is selling contracts that are backed by ratepayers. And the offer prices on these contracts are $0. So they'll take anything above that, or even including that. And the transmission ratepayers do not have control over these rights. They are not willingly selling into the market. So we have a situation is we know who has the property right to the congestion rent, or even in the case when there is no congestion rent, to the payouts, that they have the property right to not make payouts or to make payouts if they want, but they are not controlling that right. So whenever you have a market where the residual claimants to an asset do not have the agency to control that asset, that's generally bad property right design. And I don't know an economist who would disagree with that, but you know, we'll see. The other design flaw is also related to property rights, which is that the auction transmission model is different than the models that are used to generate the CRR payouts. So when you're in the auction, you're selling a very specific bundle of rights based off a very specific set of shift factors. But in the day ahead, that can be different. So the bundle of rights that you're actually settled on is different. Which just means we have not really defined the property rights that we're really selling in the auction. And of course, financial traders can profit from all differences at the expense of ratepayers. So let's go to the next slide. So I don't know if it was the last meeting or the meeting before, but we had some RTOs come in and present on their FTR type designs. And if you look at them, they were all, I think almost all of them were revenue adequate except for PGM had revenue inadequacy, but it was much milder than CalISO. But if you go to the market monitor reports for all of them, and you look at what are the, you know, what are the auction losses, how much are they selling dollars for, you can see they're losing money in all these auctions, even though they're revenue adequate or have mild inadequacy. And the prices they're selling at, we couldn't calculate for PGM from the report, but in MISO ERCOT, we got numbers around 65 to 70%, which is in line with where CalISO is now. And it's pretty clear that even if they don't have revenue adequacy problems, they still have an auction loss problem. Go to the next slide. So I think most people might understand this, but I think there are some that, you know, it can get a little confusing when people talk about different types of surpluses and deficits. So this is just a really simple picture. It's actually much easier to show this when an ISO is revenue adequate than when it's inadequate. So we did it from an adequate example, but the difference between revenue adequacy and auction losses. So you can see here you got a bunch of congestion rent, and you're going to use some of that to pay out the CRRs. And because the payout CRRs are less than the congestion rent, you have a surplus. And that surplus is passed to ratepayers, which is pro rata allocated in CalISO. So you take that money out, the ratepayers have to pay that money to the CRR holders in the auction, but in return, they get auction revenue. And that revenue is placed back in ratepayers. But if the auction revenue is less than the payments, then there's less money. So this is what people talk about returning congestion rents, auction losses. I would point out, you know, that this does reduce the hedge to ratepayers just off the bat. One thing some people brought up was that the ratepayers get the auction revenues, you know, in advance, and then they make the payouts later. That's not true. ISO actually holds on to the auction revenue and disperses it daily through the balancing account in the months and days where the CRs settle. They have an account that collects interest on that, and they pay the interest out too. I've not looked at it this last year or two, but it has been below a rounding error in the past. Maybe it's gotten up to a rounding error now. So that's one thing, and that's probably mainly because one, interest rates have been lower. You know, now they're higher, but you know, 4 or 5%, whatever. But also, even for the annual auction, I mean, what's the average term? It's less than a year. It's like, what, 7 months? That's the average term, and some are as low as, you know, 2 months. And then the monthly auction, it's like 17 days. So I don't think that the time value of money is really going to account for, you know, well, before, when people brought this up, it was before 2019, they were getting 100% returns and talking about time value of money. I'm not sure that really makes a dent in 100% return. And then now it's 50% returns. So wasn't planning on talking that part, but that data is out there. The ISO can provide it. So if we go to the next slide. So what is happening in the auction? Why are they losing it? I'm just going to focus on the first design flaw, which is, you know, that there's no agency, no choice from selling it. The ISO just offers it at zero. So if you think about like a normal market with willing buyers and sellers, who would we expect to trade forward contracts? So if you have a risk-averse party who is long on a price or a price difference in this case, that means they benefit when that price rises, and they would be willing to sell a forward contract, which is taking on a short position, for less than the expected value. So if you look here on this chart, we can see the axis is prices, you know, higher is higher, prices lower, and so you have the expected value. You know, yeah, I expect to earn, you know, the expected value if I wait and sell it in the spot market, but you know, there's risk, it might be lower. So I will sell it below I'm willing to sell it below the expected value. That's my risk premium for selling because I already have a natural long position. And of course, the price, I'd be willing to sell for any price above that as well. If you're a risk averse party with a short position, with benefits when price falls or price differences, you may be willing to buy a forward contract for more than expected value. So this would be somebody hedging, you know, a price increase, or in the CR market, a congestion price increase, you know, between their generator and their contract. So they would be willing to pay a risk premium above the expected value. And of course, they have taken the price below that. So if you look here, there's the blue line. They're willing to pay up to summer premium and anything down below. And the long position is willing to take a premium and sell it below the expected value, which is, you know, selling at a discount because they're risk averse. And then somewhere in between there is gains from trade, or potential gains from trade if they find each other. So that's what happens in normal forward markets. If we move on to the next slide. I think people have already hit on this, so I'm glad I titled this, It's Not a Mystery, because it doesn't sound like it's a mystery. The ISO is offering at zero prices, and we're here looking at what if these people don't have natural long or short positions in the market. So if you were to sell a CRR, which is taking on a short position, you wouldn't do that for expected value because you know, there's risk, and you're taking on risk. So you want a premium to make up for that risk. So you would want some price above the premium. And of course, you don't want to sell for anything above that. And if you were neutral and you wanted to buy a position, a CRR, you wouldn't pay the expected value because you're not hedging. You want to earn money. So you would buy below the expected value, potentially buy a lot because of the risk you're taking on because you're not hedging. You're just speculating on what the price differences are. So it's not, first of all, if you're selling a lot of CRRs there, then you're never going to get CRRs that are going to trade at expected value because you're selling to people who aren't hedging. And if you look at the CAL ISO CRR markets, most of the CRRs are being sold to entities that are not hedging positions in the energy market in CAISO, and when expecting to bid the price up, and they're saying the prices for most CRRs, you're not going to get good pricing. If you didn't have the design flaw where you're willing to sell them for whatever price, these wouldn't trade, but we do. So these do trade, and that's why the auction loses money. So I'll stop here for questions if anybody has them.
No questions at this time.
So I think I've heard people bring up, I'm just going to stay on this risk premium, that, you know, these are risky contracts. People are going to want a discount, they say premium, but they mean they want to buy them for less than expected value. You know, that's true if you're not hedging, again, but if you're hedging, you'd be willing to pay a premium. You may not pay one in a competitive market, depends who you're buying and trading with. But, and then they say, oh, well, you know, there's this ex post unexpected things happen. You know, January of last year. Yeah, unexpected things do happen. But if this was a functioning market where people were trading somewhere around expected values, you wouldn't expect the people selling the insurance, the ratepayers, to lose every quarter or almost every quarter for years and then lose more in one quarter. You would expect them to be earning a premium every quarter for selling insurance and taking on risk. Then when those large unexpected events happen, then they would lose. But they're made up for that by getting the premiums previously and after. It's kind of like, I don't expect my house to burn down, but I'm still paying premiums every month. But if it does, then it's a big loss for the insurance company. So I'm not really sure why people are saying, well, if we look ex post and there's these unexpected events. Yeah, that's true, but you would expect maybe in January, 2024, yeah, ratepayers would lose that month. But you wouldn't expect them to lose all the other months for years on end. So next slide. So there's been a lot of talk about deficit offsets, which is understandable. They've had a big effect on the market. But they're really a symptom of the simultaneous feasibility test, the assumptions that underlie it not holding. Now that they didn't hold before the offsets, it's just the ratepayers made up the difference when they were fully funding the CRRs. So the assumptions held, the rent on constraints underlying the MCCs that could fund CRRs, because the bundle of rights that the CRRs are buying to specific transmission constraints would generate enough rent to pay all the CRRs as if you were paying an MCC difference. And of course, that assumption is that the transmission model used to sell the CRRs is the same as the one that you pay the CRRs off of. Clearly, the simultaneous feasibility assumptions do not hold for CAISO CRRs. So if you look at the underlying constraints, the offsets are revealing that there's not a rent under those constraints to support a contract that pays these differences. If you take money from other constraints or from ratepayer pockets, which is what we did before, is either or, and those are not from constraints from which the option CRR is botting the rights on, this is not supported by the simultaneous feasibility test. The theory underlying is that, no, the rent will be on those constraints. So if you're taking it from somewhere where they didn't buy the rights, that's ad hoc. It's not supported by the theory. Deficit offsets, as annoying as they may be, are consistent with the theories of paying people based on the rent under the underlying congestion. But of course, there's the big problem for people who want to hedge. If you want to hedge the price difference, you would prefer to hedge the price difference. The deficit offsets reduce that ability. I think the ISO's presentations have shown, for some participants by quite a bit. But if you look at what happened, is the auction revenues have risen from 50 cents to 67 cents per dollar paid out. So we've reduced the value of CRRs as hedges, and the prices went up. That might be a bit of a mystery if you thought these were the majority of CRRs were being bought by people hedging risks, but that's not the case. So this is not a mystery. Go to the next question, the next slide. And if anybody has questions, just let me know. I can stop and answer.
We do have a hand raised from Abram right now.
Yep.
Can you go back a slide? So I want to clarify this issue of the deficit offsets with the simultaneous feasibility test. I guess two clarifications. One of the things that Guillermo showed in their analysis, it certainly could be the case that some of the SFT assumptions don't hold, but the other challenge that we're finding from these markets is that much of the deficit is coming from entities that are causing congestion that aren't paying for the congestion that they cause. So the filing we had 2 years ago with respect to the shift factor threshold, where loads prices were lower and didn't account for all the congestion that was occurring on the system, right, was leading to deficits. And likewise, Guillermo is showing that that is still causing a significant concern, or loop flows would be another example. Your external entities are allowed to use California's transmission system without paying. That's not necessarily a problem with the simultaneous feasibility test. So it's just important, I guess, to clarify that issue. I do think there is an issue with the SFT in terms of the load aggregate points, and I'm hoping that those guys will, that Guillermo's team will be able to look at that. Are you following the clarification here? Because I'm just not clear.
Yeah,
you seem to be saying it's all due to the SFT, but it doesn't. That's not what Guillermo said in his analysis.
No, the assumptions are that the shift factors in the auction and the constraint limits are the same as they're settled on. And so what happens with the threshold is they're not the same.
Correct.
So that is that's the difference. That violates the assumptions of the simultaneous feasibility test.
Well, I suppose you're not actually, it's a problem in the day-ahead market in that entities aren't being charged for the congestion that they cause, whereas in the auction, they actually are charged for the congestion that's occurring there. You can say that's a problem with the simultaneous feasibility test, but in fact, when we reformed that with respect to the shift factor threshold issue, it was a change to the day-ahead market that was attempting to fix that issue. Just one more quick point on your slide here. On your last bullet point here about deficit offsets having reduced the value of CRRs or the auction revenues increased from 50 to 67%. That's simply definitional, right? So you will see an increase. It's in the definition that California uses. If you charge entities for that underfunding and reduce the profits, and you measure the auction efficiency as, how much of the dollars paid out are returned, it's just definitional that you will, by having deficit offsets, you will increase it. It's not, I agree with you that it's moving from 50 to 67, but it's just in the definition. It's always going to go that way.
Okay, well, so before we had
you wouldn't say that we should auction something off and charge it over, 200% underfunding. If you had a rule that settled all the FTRs at zero, you wouldn't think that that was a good market design, right?
So the point that bullet point's trying to make is, before you had full funding, you knew you're going to get that price difference. Now you don't know what you're going to get. So the value of the hedge is lower. So you would say, okay, look, I'm going to get a, say, notional value of $100, but I know the offsets are generally 30%, so I'm going to get expected to be 70. And then I'm like, well, but am I going to get 70? You don't know, so it's riskier. So you would expect the value to go lower. So the value on the net payment, if I was hedging, should, you wouldn't expect me to start paying more for that dollar than I was before if I'm trying to hedge risk.
Yeah, and so what you're measuring, that 50 to 67, is what we can actually measure. What you don't see in that 50% number is how much of a risk premium is put on the fact that there is underfunding. I'm not talking about the uncertainty with respect to what it might clear for. I'm just talking about, oh my God, I know that there's a lot of underfunding. Some market participants leave the market. Other market participants lower their value, so the load gets less auction revenue for its rights. And that's not even measured at all in this 50 to 67%. So you really don't know. I mean, ultimately, what economic theory would tell you is load is going to pay regardless if there's these deficits. And, so the deficits are likely to create more uncertainty and cause people to discount the CRRs even more. And you see that from the LSC market behavior of more sales in the auction and some physical market participants leaving the market. And so what you're not measuring with the numbers that you're seeing with the Cal ISO analysis is how much of a discount did people put on the CRRs because of the uncertainty about funding. But you'll always see an improvement if you're charging the deficit offset back to the actual CRRs. It's simply definitional there. It doesn't tell you whether load actually, I mean, what David Patton said in the FERC technical conference on this issue back in 2016 is he was very clear. Load is going to pay anyway, because if you make this product incredibly uncertain and have a lot of underfunding, that the entities that are buying the CRRs will discount their value. And that's how you get down to where that those lower prices.
Yeah, but the prices went up. And the point is, now I'm buying, expectation, because now I'm not getting full funding of $70. Why would I, before, when I knew I was getting guaranteed whatever the price difference was, and I knew what the dollar, I knew I was going to get that megawatt quantity, why would I pay 50 cents then, but now that it's worse, why would I now pay 67 cents if I was hedging?
If you know you're going to get full funding, you'll pay more for them. There's no question of that. But I think you're mixing up some concepts here in terms of the 50 to 67. If I'm understanding what you're presenting is that the deficit offset has is increasing the auction payouts in terms of, I guess maybe I'm not understanding what this last bullet is actually saying.
So when you're saying definition, I think you're saying because the offset's included in the net revenue calculation. And, nobody's buying notional values. They're buying their net values. Before the net value just was a notional value. So if you were to look, at somebody hedging and like, wow, this is not as valuable as a hedge, I'm going to pay less for it. What you wouldn't expect is the net price paid for the net dollar I'm going to get to go up. You expect the auction revenues to go down.
Okay, I guess I'm not clear on what the 50 cents and 67 cents refer to, but we can move on this one, this latter point.
Okay, we also have a hand raised from Noha.
Hi, thanks so much. So I guess maybe if I could, I don't want to belabor what you and Abram were just talking about, but in my mind, there are two types of premiums. There's a premium for the risk of underfunding, and then there's a premium for I'm buying this position now, and I don't know what's going to happen, whether it be outage scheduling, whether it be, a crazy weather event, whether it be a war starts and we see a big differential in gas prices. And if I'm hedging, I want to make sure that I have some insurance against those events, but I'm also still going to have a discount premium because there's so many unknowns between now and then. So I don't know what really, I wasn't following your example clearly either, similar to Abram, but these are sort of the two premiums I think that you're viewing as inefficiency. But really, the first we can solve for, which is let's look at what's causing the underfunding and attempt to solve that. The second
So
is
the point
just a general.
of the number is if you expect them to be hedging and you reduce the value of that hedge, they would want to pay less for that hedge. And so if the market was primarily selling to people hedging contracts and that was setting the prices, you would not expect the price to go up. That's the point. I got to keep moving on. Is there, another question that's different than Abram's, or?
Yeah, I just had one other point on your comment about the earlier. I didn't realize we were going to be taking questions as you were going through your slides. Your comment about if you look at their market monitor reports, I just don't think that's true. I think it would be great if CAISO staff could ask Dr. Patton and other market monitors, maybe other than Joe Bowring, who has already been rejected at FERC and by the courts, to come, because they are all very supportive of FTR markets. They all understand the need for hedging. So I think to say, that they all criticize FTRs in their market monitor reports is just simply incorrect. Thank you.
What we're saying is that the market monitor reports show that the auction revenues are consistently under the CRR payouts, despite revenue inadequacy. So if moving to revenue, fixing revenue inadequacy is not going to change the underlying problem of the auction.
They all say that their markets are functioning correctly, and everyone in those markets that is putting real dollars at work in those markets is very happy with how they're working, and all the load serving entities and PJM supported that filing. In MISO, they're all very supportive. So I just want to echo those things. So how you're measuring it is very different. And I think how you're stating that they're stating it in the market monitor reports was not their intent in any way, shape, or form. And if Dr. Patton was here, I think that he would be very concerned about this, the way that the narrative is being described here.
It's just saying that the auction revenues are below CRR payouts. It's pretty straightforward.
I appreciate you explaining that to me.
Can we move to the next slide? So you can see here, the auction revenues increased by $24 million per year, while the net payouts decreased by $27 million. If you just look at the auction revenue number, you can see there's not really a fall in it. What's really happening is the payouts are being chopped off. In fact, if you were just to calculate the notional value, dividing the auction revenue by the notional value, you'd get about 47 cents, which isn't that far off from the 50 cents that was before. So, one of the biggest, probably the biggest, if not the, maybe almost all the change in auction efficiency has come from the offsets. That's where the ratepayer losses are being reduced. Move to the next slide. The ISO, they spent a year, analyzing the causes of revenue inadequacy. I don't think there were any surprises, at least not to people who were in the previous process. Back in 2018, that the root causes are shift factor threshold, power flow contributions from loop flows, and just all the modeling differences in the market. The ISO has made lots of efforts to improve revenue inadequacy over the last almost decade. We're not against incremental improvements, but they don't fix the fundamental flaw in the design of the residual claimants not having agency, not being willing sellers of their rights. So we're not sure how, doing more and more analysis is going to tell us anything new or actionable that the ISO hasn't found the last, since the last process. We move to the next slide. When we look at allocated CRRs and we just look at their notional value, we can see that compared to the congestion rent net of ETCs and TORs, this isn't the total congestion rent, it's the total congestion rent after the TORs and ETCs have been paid. Their notional value would have averaged a surplus of 72% of congestion rent since Q3 2020. I know because people are very interested in Q1 2024, January 2024. If you remove that, it's about 15%. After the auction, the CER revenue adequacy shortfall is 25%. So that's a swing from, plus 17% of rent to negative 25% of rent. It's a pretty big swing for using the same transmission model. My understanding is that a lot of allocation nominations do not clear the allocation. So you're not clearing all your allocated CRRs. Those lines are full, yet running the auction afterwards, you get a lot of revenue adequacy. Are there any questions on this slide?
We do have a hand raised from Torsten.
Torsten Keeper, can you hear me?
Yep.
All right, great. Yeah, this is Torsten Keeper with Flynn Resource Consultants on behalf of BAMX. And I wanted to add a little bit of color to the previous discussion about the other market monitors' evaluations of their FTR and ARR products. And I'm doing this because I just so happen to have the 2024 PJM State of the Market Report from Monitoring Analytics open as that discussion was happening. And from my reading of this report, it really does not sound to me like Monitoring Analytics, which is the market monitor, feels that this market is performing as designed. They indicate that the market design is flawed. They say that it is partially competitive, and they go on to describe what they call inappropriate interventions by that ISO in those markets. So just wanted to provide some color there. That report is posted publicly on Monitoring Analytics website. So I'd encourage anybody who wants to take a look at that to go find it. Thank you very much.
Thank you. I would point out, I don't think when CRRs are developed, people expected them to be being sold below expected value consistently for years on end.
No other questions.
All right, let's move to the next slide. So, what's the fundamental problem with the funding, the auction losses? It's the auction design. You have design that is just not consistent with, fundamental good market design having good property rights. And what happens is, because the ISO's auctioning these off at $0 reservation price, ratepayers are taking on risks for negative expected value. I don't think that's an appropriate market outcome, and you do not see that in a free market without intervention. Most CRs are not purchased by any of these hedging risks in CAISO energy markets. The assumptions underlying simultaneous feasibility tests, they do not hold in CAISO. That's a big problem. If you're trying to design a marketable security and make a well-defined property right, fixing the revenue adequacy is not the same as fixing the auction losses. It's probably not going to fix the auction losses. It may reduce some of the opportunistic behavior, but not all of it. CRRs that were allocated were revenue adequate overall. Revenue adequacy comes after we include the auction. And I think this is a point because people keep talking about these benefits outside of the market. It's okay that there's losses. Well, a market, we have market prices, this is not the market prices we would expect in a competitive market. And they're saying, well, it's okay, that they're selling at a loss and ratepayers are taking on risk and expect value because these cost benefits of some other, other benefits outside to other markets or to other contracts. That sounds like a cross subsidy to me. I'm not sure what the actual economic theory is that says that, selling, CRRs at a loss is beneficial because it distorts prices in other markets or distorts costs in other markets. I'm not even convinced that most of these CRRs are going to anybody that are trading in our, other forward markets. But if you do want to subsidize contracts for hedging, that's what you want to do. The CRR option is not very effective at doing that. It's not targeted and limited to achieve that purpose of whatever those subsidies are. So if you want to have some sort of cross-subsidization where ratepayers are taking on the risk, so there's less risk in other markets, and they're being, they're losing money to do that, seems like you'd want to have a system that targeted and was limited to achieve the purpose of where that subsidy is. So rather than just throwing a bunch of them out there for people to take. Next slide. Also we have the willing seller approach. We've talked about this, Frank Wallach wrote his paper on that, did a bunch of analysis with his grad students at Stanford. Under this, you don't really change the allocation process, and unless there's any small changes you need to find, because eliminate the deficit offsets. You just run consistent with other forward markets. ISO doesn't intervene to sell. And of course, LLCs can resell their CRRs that are allocated, or financial entities, or marketers, and hedgers can all participate in that market. And you wouldn't have any of these restrictions on the locations that you can bid at, and they would all be fully funded. They'd be fully funded regardless of the revenue inadequacy on a COD ISO system, or any separate entities from outside systems. It would all just, because it'd be all based off prices and winning counterparties. So that's the end of the presentation. I will hold for more questions.
Thank you. We do have a hand raised from Noha.
Sure.
Thank you. Yeah, I just wanted to address Torsten's comment earlier. Torsten, the PJM, IMM, Dr. Bowering Monitoring Analytics is who I said in my earlier comments was his proposal similar to what the DMM is proposing here, was rejected at FERC. That was addressed in Casey's presentation earlier, and also rejected by the courts. His analysis on underfunding was also rejected in 2 PJM proceedings addressing underfunding, and you can see the docket numbers obviously posted at FERC, but the docket numbers are referenced in Casey's presentation as well. I was referring to the market monitors in ERCOT and MISO that were presented at the last meeting, are both very supportive of the structures. Both have said underfunding is incredibly bad for the market. And as far as, these dollars harming ratepayers, I will say this: I think that underfunding is not great for ratepayers, and that was covered at length in that technical conference covering underfunding. So I would encourage you to watch that and watch Dr. Patton's comments that Abram referenced earlier, that, load pays either way. And, the DMM's concern here is that there's a premium because of underfunding. You would get more value for the product if this underfunding wasn't there. And that's really important. And if you look at both the LEI reports for both PJM and MISO, they actually both highlight the benefit to ratepayers, including the fact that in MISO, stage 1B ARRs would not even be funded if there was not liquidity in the FTR market. Those are all publicly available documents, so I would encourage you to take a look at those. And again, Dr. Bowering has pretty much advocated against a lot of things PJM has done, and most of the time FERC has rejected his arguments specifically regarding the FTR market. Those have all been rejected. Thank you.
Thank you. We also have a hand raised from Seth.
Roger, I just have a question for you. Like, given that you've cited all these problems, and I think I can trace back some of this probably 12 years ago, where you guys have been citing these problems. What's your course of action, given that you still contend that the auctions aren't acceptable, or they're not fulfilling their function?
Well, we would like them to fix the auction, and we believe the best way to do that is to make it more like a standard product in a standard market where you have willing buyers and sellers trading products. But I think it's pretty clear, just looking at the data, that the auction is not functioning like anybody would expect a competitive market to work.
Okay, thank you.
We have another hand from Abram.
Hi, thank you for this, Roger. I do have a question here, just to think about a little bit. So when FERC issued Order 888, they required transmission owners to make available the sort of, in the OAT context, transmission without regard to the value of that wheeling power. It's sort of a requirement that the transmission owners make transmission capacity available for people, say, to move power from a low-cost area to a higher-cost area. So when that is happening in the West, currently in the markets that have continued to have OAT rights, and a transmission customer signs up for that right and is able to move its power from a low-cost area to a higher-cost area, would you also define that as a loss to the transmission ratepayers that are required to offer that transmission?
They pay the regulated rate to do so.
Exactly. They pay the regulated rate, but it's not with regard to the value of the wheeling power, right? So I mean, because transmission owners oppose this order, because it would require them, it would be much easier for them, as you know, back in the 90s, to be able to move their own power across their transmission system to be able to sell. But it's not with regard to the, I'm just wondering if you would regard that as a loss to ratepayers. Let's say they have to pay $3, but they're forced to sell power that turns out to be worth, $500. And the regulated utility would have been able to capture that and reduce the cost to its customers, had they not provided that to some competitive supplier.
Yeah, I mean, I believe, I'm pretty sure the way it works, and I'm not an OAT expert, is that, you have your firm right holders, and they, pay the firm rates.
Correct.
Then if they don't use it, then it's released to, anybody who wants to buy at that other lower non-firm rate or sort of shorter term rate. So it's not like, they're taking, I think that's how it works. I'm not really sure how your example will show that, because if they have the long-term rates, they could flow the power.
Initially, they offer it, so somebody who doesn't use it, but initially they're offering it to market participants and entities in the West, like Seth's company, for instance. They'll sign up for it, and they'll use that to move their power to meet their customer demands, but presumably, if the power was worth more where it was located, they wouldn't want to move that. And I think that it's not that we're measuring it or able to measure it, and we don't have ISO prices that show, but I suspect that there's a lot of value in terms of the dollars of people who have OAT transmission rights that they've paying the tariff rate for, that has a lot of value that would otherwise potentially go to their customers, their load serving entity, the ratepayers.
Yeah, hey, Roger, I'll make a comment on that. This is Eric Hildebrandt with DMM. I think a key difference is if you buy under the OAT system, if you buy transmission rights, you only get the benefit if you actually schedule power. And CRRs, so obviously people doing that, the people buying that, the entities buying that are interested in using it as an actual hedge for physical power. Whereas with congestion revenue rights, we see most of them being bought by entities not scheduling power, and they're collecting congestion revenues, for all hours, not just when they're physically using the capacity.
Right. Well, the CRRs are, there was an interesting presentation at the MSC last week by Scott Harvey explaining how the movement, the use of CRRs to replace those physical rights actually just tremendously efficiency enhancing in the ISO context. So you're not suggesting, Dr. Hildebrandt, that it's somehow superior to have those use it or lose it rights. And I'm not sure that answers the question about whether OAT transmission that people sign up for and pay for, whether that isn't exactly equivalent in terms of representing a ratepayer loss to the ratepayers who are required to make that available. I think FERC's theory of the case is that the cost to ratepayers will go down when competition is enabled by allowing for the transmission to be used by other entities. Even though if you measured it, it probably would look like a ratepayer loss.
Okay, well, I've given my best response that there's a significant difference between the two. So I'll let Roger get back, maybe sum up. I know we're running out of time.
I'm not sure that it's a relevant difference to the question.
Oh, all right.
Yeah, and I'd just say again, they are paying rates. So I don't know, like if you're thinking auction CR should pay some tax charges or some discounted tax charge, I'm not really sure what you're getting at.
Okay, we do have one more question from Todd in the room.
Yeah, I'd just like to weigh in on Abram's comparison. I do not agree that comparing it to as available OAT sales is appropriate in this context. As I understand, the OAT sales do go back to transmission ratepayers and potentially reduce rates. So and secondly, that those are not market-based rates. So if they were to be selling as available transmission at market-based rates, I'm sure most commissions would view selling at a lower price as reduced value to their transmission ratepayers. So I think in the context of a CAISO market, it is appropriate to view the underlying expected value of the CRR and comparing what the actual price the people are paying for it as a measure of whether or not ratepayers are getting an appropriate amount. That the reduced price is a true opportunity cost to transmission ratepayers. So, thank you.
I think, Abram, is that a new hand?
In discussion, I can mute.
Oh, okay. Sorry. Thank you.
Yeah, I'll just echo what Todd said on the, I do not remember reading anywhere on the, up on CRRs that, oh, and we expect these to sell at a discount to their expected value consistently. I think there was an expectation that these would sell for their value, and they wouldn't be, generating huge discounts, particularly people who aren't using them to hedge energy contracts. So, yeah, I think it's pretty clear that, these reported ratepayer losses in the metric and the auction efficiency measure, the CAISO reports, those are very relevant metrics. If there's no more questions, that's the end of the presentation.
Thank you, Roger.
Yeah, no more questions at this time.
Now that we are approaching noon, we're going to make a small schedule adjustment here. We will have our final stakeholder presentation, Doug Boccignone, representing BAMX, after lunch. So we will pick up again at 1 o'clock. Thank you, everybody, for your for the discussion this morning, and thank you, Doug, for your flexibility schedule-wise. We will see everybody in an hour. Welcome back, everybody. Thank you all for rejoining. For anybody who is joining us now who was not here in the morning, excuse me. I'm Hillary Staver. I'm with the Market Policy Design team. I'm here with Partha Malvadkar, and we've got a small adjustment to the schedule. We had a very robust discussion this morning, but for anyone who's just joining, we are going to pick up now after lunch with our final stakeholder presentation of the morning. Now afternoon, that will be Doug Boccignone representing the Bay Area Municipal Transmission Group. Doug, are you here with us and ready to start?
I am, thanks.
All right, well, we will hear from Doug, and then we will proceed into the rest of the scheduled discussion on analysis, goals, and problem statements through the rest of the afternoon.
Thanks,
Thank you,
Hillary.
everybody. Doug?
Yep, thank you. Can we go to the next slide, please? So I'm Doug Boccignone. I'm with Flynn Resource Consultants, and I'm presenting today on behalf of the Bay Area Municipal Transmission Group. The members of BAMX are the Silicon Valley Power, which is City of Santa Clara's electric utility, and the City of Palo Alto Utilities. I'll talk briefly about, with some background in the methodology we use for our analysis, talk about our findings from our analysis of the FERC quarterly report data and CRR participation in 2024, talk about our conclusions and some recommendations. If you could go to the next slide, please. So, there's been a lot of discussion throughout this initiative working group process, and again this morning, about one of the purposes of CRRs being to be the financial equivalent of firm transmission. And that's critical. It's, as people mentioned this morning, FERC has ruled repeatedly that that's an important purpose of CRRs, not just to provide, to return value to load. So we asked the question, well, are CRR auction participants using CRRs as the financial equivalent of firm transmission? Or put another way, are they actually using transmission? And so what we did is we looked at the FERC quarterly report filings that have been submitted for 2024. These are required filings of public utilities. Some consumer-owned utilities don't have to make these filings if they're below a size threshold, but they often show up in the filings as customers because the sellers of energy have to report the volumes of their transactions and the counterparties and prices. There's a ton of information. So what we did is we looked at the EQR data. We looked at all of the buy and sell auction CRRs that were transacted by each CRR auction participant. We looked at the EQR data that was reported for every P node within the CAISO Balancing Authority area. And we also looked at hub transactions that took place at the boundaries of the ISO. Most of these would have been at Palo Verde or Malin, but it basically ISO interties. We excluded transactions that were reported that were outside of ISO. There were a few, a handful that I think were misreported as being in ISO. But, for the most part, it was pretty straightforward translation of the data. And then we identified all the CRRs that were bought and sold and the EQR sales and purchases that were reported for each of the auction CRR holders. Can we go to the next slide? So just to give some context to this, it was, I think, discussed this morning, there's about 240 terawatt hours of CRRs that were purchased in the CRR auctions in 2024. 58 terawatt hours were sold, so basically either resold purchased CRRs or sold allocated CRRs. And just for some reference, the ISO allocated 183 terawatts hours of CRRs. And I should just mention here, ISO allocates and auctions CRRs in megawatt quantities, but they're megawatts for a period of time. So we converted those quantities to megawatt hours so that we could compare them to the energy sales data that was reported in the EQR transactions. The allocated CRR participants sold 43 terawatt hours of the allocated CRRs, which amounted to about 3/4 of the sales in the auction. So pretty significant chunk of the sort of resold CRRs came from those allocations. ISO's gross load as reported by the participating transmission owners for 2024 was about 200 terawatt hours. Just give you a sense of the relative magnitudes of the energy we're talking about here. The reported EQR sales for 2024 were 468 terawatt hours. So, and the energy gets sold more than once, so it's not surprising that the volume reported exceeds the actual amount of load served. Let's go to the next slide. So in terms of our findings, I have a chart I'll show in a minute, but just at a high level, it's pretty clear that how the CRRs are sort of distributed among the auction participants is not linked to the participants' use of the transmission system. 90% of the auction CRRs were purchased by entities that represented less than 10% of the physical EQR transactions, either buys or sells. Most of these you'll see were held by financial entities or marketers. And those entities tend not to participate as physical energy buyers or sellers. There are some caveats. Some do participate and they're reported as buyers or sellers in the EQR, but they often purchase significantly more CRRs than the reported physical energy that they transacted. So they might have some portion of their business as physical, but they're participating a lot more heavily in the CRR auction. But there are some marketing entities that do have sort of comparable amounts or even greater amounts of physical market participation as their CRR participation. And, not surprisingly, they tend to have a lower impact on the amount of the auction inefficiency than the entities that aren't participating in the physical markets. I mean, basically, it appears that they are doing some amount of hedging. And and I should say, this assumed the sort of the average offset or CRR clawback, which is 20%, about 20%. In reality, the individual participants will, experience different amounts of that clawback. So let's go to the next slide, please. So can we go to the next slide? Thank you. So there's a lot going on this slide. I'll try to explain it. What we did is we tried to show on the y-axis is sort of percentage of either the CRR market or the EQR physical market. And then that's on the y-axis. On the x-axis are the individual CRR participants. And then we've grouped them by entity type as classified by Department of Market Monitoring. They basically identify which group each participant fits within. And then what we did is for entities that had EQR data but don't participate in the CRR markets, they weren't necessarily assigned an entity type by DMM. So we just use our judgment to put them in, and then they show up at the end of each segment on this chart as sort of non-CRR participants, so that we can capture their physical energy in the chart. And the red line that's sort of upward sloping, starts down at the bottom left, that represents the cumulative share of the EQR sales that were reported in 2024. The sort of purplish line is the share of the EQR, the buyer side of the EQR transactions. The dark blue line, kind of up on the left side of the chart, represents the share of the CRR, the buy side CRRs, and the green line is the sell side CRR's share. And I'll come back to it, but the light blue line is within each segment, it's showing the share of the auction inefficiency or shortfall. Again, assuming this sort of 20% average. So don't read too much into the individual entity share. It's sort of an overall look at things. And so, what I kind of take away from this is the financial entities in particular have just like a minuscule share of participation in the physical markets. Not surprisingly, they're trading the CRRs without participating. Most don't participate at all. I think we're talking about cumulative share of the financial entities is a couple of percent in either the physical buy or physical sales. The marketers tend to participate more in at least some of them in the physical markets. Some don't participate at all, but some do. And then there's this group of BAAs, which some of them are actually acting as market participants in a way. And we have the generators and the load serving entities. And I do want to mention, it's not surprising that the LSEs don't participate as buyers much in the auction because they get allocated CRRs. But they are significant sellers of the allocated CRRs. In terms of this contribution to the auction inefficiency, I think, so that's like the difference between the light blue line and the dark blue line. This is showing that most of it is coming from the financial entities. And I contrast that with the marketers and the BAAs where, some of those entities are actually hedging, and the hedgers contribute less. You know, they are paying premiums for the hedges. It's a little surprising to me that the generators show up as also contributing to the auction inefficiency. I think this is driven by what Abram was referring to earlier this morning about the January event, because there's at least one generator who did anticipate that event and took a pretty significant south to north position at Malin and made a lot of money. And I think that sort of shows up as part of this shortfall. Whereas most of the generators sort of look more like the LSEs. The line is pretty flat, you know, on this cumulative line. In past years, when we've done this analysis, we've seen the generators actually look more like the marketers, where they're you know, paying a premium for the hedges. But I think this January event sort of changed the picture. The other thing that could be going on is that the entities may not be properly classified in this list of entity types. DMM just released their listing last week, and they've invited market participants to weigh in and comment of whether they think they've been categorized appropriately. I encourage people to look at DMM's posted list and let them know if you think you're in the wrong bucket, because I think it could change this analysis. So I don't know, maybe I should pause to see if there's any questions about the chart before I talk about conclusions.
We do have a hand raised from Noha.
Doug, this is Noha on behalf of ETI, but I really also just want to talk about it from personal experience, and we've tried to dissect this data in other markets as well. I will definitely look at the categorizations in the DMM's report. But one thing to think about is there are folks that are financing certain things or helping folks manage their basis risk that might have CRR positions on. And so they're deemed a financial participant, but really they're selling somebody a fixed for floating swap, or they're helping someone hedge to get financing for something. So there are lots of like commercial reasons why somebody would participate in an agreement like that. And then as a result, the person that's providing that, you know, I'm going to use the term insurance loosely here, is hedging their exposure in order to be able to offer the fixed contract in the CRR market. So
Yeah.
just something to think about.
Yeah, no, thanks. That's good to consider. You know, I think though in the end we have to think about like who's providing the insurance, and you know, what is the CRR supposed to be doing here? But you know, I think you are right that, you know, there isn't necessarily one role that any entity in any of these buckets plays. But I think the actual like results of, are they paying a premium for the hedge, which the economic theory would say they would do, or are they, you know, speculating and making money on the speculative activities? Okay, any other questions?
Oh, sorry, no other questions.
Okay, great. All right, let's go to the next slide. So, you know, I guess our basic conclusion is that most, not all, but most of the financial and market entities don't appear to be using CRRs as the financial equivalent of firm transmission. Hold on one second. Sorry about that. You know, it's pretty clear they either don't participate in physical energy transactions and aren't using, and therefore they aren't using transmission to participate. they're not using the CRRs as a financial equivalent of firm transmission if they're not using any transmission, or they're participating to a pretty small degree relative to their CRR market participation. And my conclusion is that it's unlikely that this type of auction participation would have a material impact on liquidity of the physical energy market because they're not participating in the physical energy markets. You need to make that linkage. And, I think some of the marketing entities clearly are participating in the physical markets. Some not nearly to the degree that they're participating in the CR markets. But the converse is also true. There's marketing entities that have greater EQR market participation or market participation that's in alignment with their CRR participation. And I think that activity sort of contradicts the idea that you have to have this financial churn, to get the liquidity. I mean, you've got people who actually have physical exposure participating in CRRs to a lesser degree than their physical exposure. So, I think there needs to be some explanation for that. I don't know what that explanation is. Maybe Noah can help us out after we get through this slide. But, there's a real impact of this because the entities who aren't actually using the transmission system, who aren't injecting energy and withdrawing energy from the system, yet are collecting congestion revenues via the CRR purchases, are reducing the amount of congestion revenue that's available to the entities that are actually using the transmission system. And, most of those entities are paying the embedded cost of the transmission all year long. And, some just wheel through and they pay it when they wheel the power out. But they're paying for that transmission. And they're actually really exposed to congestion. And I think thinking back to the comment about the January event, I recall that Guillermo said that the parties who bought those auction CRRs for January, south to north at Malin, only actually scheduled energy for about 50% of their CRR positions. So, that I view that as, they only needed to hedge half of the position they took. And again, I mean, it's a sort of an anomalous circumstance, but I think what we're seeing more every single day is there's a bunch of CRRs that get transacted, basically paid for by the load serving entities who have to fund the system. And they're getting sold at a tremendous discount. So I want to talk about recommendations. If we can go to the next slide. Can we go to the next slide, please? So we have a few recommendations. First, we think parties should review the entity classifications and those should be updated, just to make sure we're sort of properly identifying parties. It would be really helpful if we could apply the CRR offset calculations for each entity rather than using system averages. It's possible that some of the entities actually had greater clawbacks, made less of a profit on the CRRs than is implied by the chart. But the converse could also be true. Maybe parties anticipated better, some better than others, what the offsets would be, and they, that was reflected in their purchase decisions. So it would be interesting but very difficult to make these calculations for every market participant. The other thing I think would be really helpful, and we've sort of partially started this process, which is to examine the locations of specific EQR and CRR transactions to really better understand whether the CRRs or how the CRRs are being used as hedging instruments. You know, what I presented here was just aggregate level information, and it doesn't really reflect the specific locations where people held CRRs and actually transacted energy. You know, so those are sort of suggestions, recommendations for further analysis. In terms of for this initiative, we recommend that the parties explore limiting the amount of transmission that's made available in the auction, similar to how allocation CRRs are limited based on parties' historical usage of the transmission system. Right there now, there really is no limit to how many auction CRRs can be purchased by an entity. I mean, the underlying system limitations apply, but for the allocation, you know, it's based on people's actual historical loads. And we think something similar could be done for the auction process. And then at the same time, we think there should be further exploration of the willing seller auction approach, similar to what DMM has proposed. You know, if that were adopted, could it provide reasonable hedging opportunities for parties that use the transmission system so that we could meet the FERC requirement that the CRRs, FTRs act as the financial equivalent of firm transmission? And, you know, just my last point, I think, at least based on the data we've looked at, that is the CRRs aren't acting as the financial equivalent of firm transmission for parties who aren't actually using the transmission system, that they're serving a different function. For the parties who are using the transmission system, they're meeting that test. But for 90% of the CRRs that are out there, doesn't pass that test in my mind. And that concludes my presentation. I'd be happy to discuss this further if people want to weigh in.
Thank you. I believe there's another question from Noha.
Yeah, Doug, I wanted to touch on a couple of things. One is your example of, you know, the generator that you said, you know, had their CRR volume was 50% of their physical volume. And I think it's really easy to look back at an event like that after the fact and look at the dollars. It's really important to remember that hedging is also an art, not an exact science, because it's not always dollar for dollar, and it's quite possible that generator, and I haven't looked, but you know, they might have tranched their volume. Like at a certain amount, they were willing to buy more insurance because they didn't know how bad the event was going to be. So it's not as easy as like, you know, I'm going to hedge the exact amount. It could also depend on your hedge budget, and it's very possible that they tranched it and got more volume and thought, oh, you know, this is exactly what we need to hedge against this event. So it's, you know, I would not look at all of these events in hindsight and assume that it was so easy to make the decision in the moment.
I think that's an excellent point. And I guess my response though is, and I totally appreciate it in this or any circumstance that could be the case, but I also think that I would not expect to see consistently month after month, year after year, that the people who are buying those hedges would be buying them at a discount, at as great a discount as there is. I mean, they should be paying. I would expect to see a premium paid for the hedges, and you know, sometimes they would make money, or you know, make more money. Sometimes lose some money relative to their expected position, but we don't see that. It's very rare that we see that in this auction market.
So I'll tell you a couple of things from my perspective, and I think that well, first of all, I agree with your ask that we should get the basically the underfunding data by market participant. I think that's a big issue. The other issue is since this underfunding is really only displayed in settlement, there's no transparency. So there's no way for me to know if I didn't trigger the constraint that was underfunded, how much the underfunding is going to be. So you may be seeing that big discount because of that as well. Like nobody really has a good idea over like specifically how much you are going to be underfunded. I don't disagree that there's not a discount. There's definitely, there are improvements to be made. I think we wholeheartedly agree with that. But I don't think you can measure efficiency at the same time as having underfunding that forces folks that are trying to hedge to go negative. I mean, and you're hearing this from physical market participants as well as folks that are, you know, financing assets and and that are, you know, running CRR operations. So you are hearing it from multiple parties. I would urge you to just have an open mind that I do really think we need to solve the underfunding issue because it's been happening for a long time. And in other markets, it actually cannot go negative the way it does in CAISO. So that's a really big point when you think that your hedge is actually going to become a liability. So just food for thought, and I wanted to just share that hindsight point.
Yeah, no, I think that's a fair point. I mean, I just would say that, I mean, even with allocation CRRs, sometimes it goes against you, right? And you know,
but it doesn't. Has it created a liability for you? There's one thing as of the
oh,
CRR going against you, but
no, I mean, I
like
think
you think it's positive, and based on what you're seeing in the LMPs, it's positive, but then in the settlement, it's not.
no, I understand that point. I think, you know, that clearly is something that we should be looking into as part of this initiative and ways to address that. I guess what I'm getting at though is that I don't think that's going to be enough to fix this problem. If we're going to continue to sell off transmission that, you know, basically, you know, if anyone's willing to pay $0 or more, they can get, and you know, Kate, you know, a lot of the times nothing happens, and then you know you hit a home run, and you know, to me that's just, you know, the participants are speculating. They're using the investment that other parties have made in the transmission system to collect money, and I don't. I mean, people refer to this London economics report, but first off, it wasn't done for the ISO market. And I don't even think for PJM, it did a very good job of proving that the FTR markets are actually enhancing liquidity. They're actually contributing to lowering the costs. I mean, there were some assertions that was happening, but you know, there was a lot of arm waving and not a lot of evidence in my mind. And I welcome evidence that those benefits are being provided here for the California ISO markets.
Yeah. So a couple of things on that. I'm curious what you think they hand waved on because they looked at the EQR data, same analysis you did. They also looked at the nodal exchange data and saw liquidity right after the auctions. They saw the EQR data tie into the FTR data. They also reviewed financing agreements for combined cycle units that went into place from 2017 to 2019. They did a very thorough analysis that all the physical participants in PJM agreed with. Like the only person that did not like their analysis there was the market monitor. I mean, even Chairman Christie, Commissioner Christie at the commission now, you know, agreed with the London economics reports. I'm surprised to hear you. I would just be curious, and maybe we can talk offline about what you thought they weren't specific enough about.
Yeah, I think we could follow up.
Yeah, absolutely. I would welcome that, please, because I do want to better understand your concerns and also, you know, share our concerns about the fact that we're trying to discuss efficiency of a product that has been malfunctioning for multiple years now.
Yeah, I guess what's troubling to me is I don't see the connection, the nexus between the physical market and this financial market is very, very thin. When, 90% of the CRRs, the buy side CRRs are held by parties who are represent less than 10% of the physical transactions. That, how is that driving the liquidity of the markets?
So then I guess what's your view on open access and the MISO report that showed that without the non-physical participants, that without the financial participants, that the stage 1A2, the second round wouldn't be fully funded?
Yeah, I guess my view is the physical participants, I mean, we could give them CRRs, all the physical participants, and we would be better off than holding this auction. Like if people could, and I'm not saying we should do that, but I'm just saying that's how bad the situation is.
You're saying you don't feel like you're getting enough value out of it.
Yeah, clearly not.
Right.
And I think how can you, first off, we have open access in California. Every market participant can inject or withdraw at any point. The question is, can they get a hedge? And what I'm saying is, if they could, I think what we should do is make parties demonstrate that they need the hedge. Make them demonstrate that they're going to actually inject or withdraw energy at those points. And if they are, then let them participate in the auction. Because we've tried it other ways and we're basically not putting any limitations. And that wouldn't harm their ability to get the financial equivalent of firm transmission. In fact, it probably cost them less.
So I think, FERC's definition of open access was really to inject competition in the markets beyond physical participation. Because obviously physical participation is more costly, there are more hurdles. And so one way to do that was to create the financial market overlay. I'm not saying that you shouldn't be getting more value out of this. We wholeheartedly agree that there are improvements that should be made so that, and we agree that one of the purposes of the CRR product is to return dollars back to load. You should be getting value for your contracts. But I wouldn't point at it and say we're not getting value because of financial participation. The financial participants are supposed to be providing more liquidity so you can gain value. I think we should be looking, and I think you and I are on the same page about this, we should be looking as to why you're not getting that value.
Yeah, I guess where I struggle a little bit is some of the market makers. I mean, we've heard from them in the last meeting. They're not participating to anywhere close to the degree in the financial market as they are the physical market. In other words, like if we applied the limitations I'm talking about on them, they would be fine. They could get as many CRRs as they're getting today. No problem. And those are the ones who are actually to me, they're in the market as both a financial and physical player. So why are we, I mean, in my view, the people who are funding the transmission are subsidizing the financial entities, not the other way around.
See, I think this is where we need the underfunding data, because I would beg to differ. When we did analysis last year and the analysis we filed for the shift factor cutoff filing, the financial participants were actually funding a lot of the overfunding for the LSEs.
I think that's a very specific segment of what we're talking about here. I mean, the shift factor issue is an issue. and one that, hopefully can be tweaked to be fixed. But that's just one element.
So I think that these other causes of underfunding are also causing this. So I wholeheartedly echo your request that we should get the underfunding by market participant, because I think the number, you will be surprised at the numbers that you see. I think that part of what you're gaining here is actually coming from the financial community. I think it would look much worse without the financial community.
Yeah.
But Partha, I think that would be a terrific thing for CAISO to provide, because none of us can present that data. And we could do it as a company specific for some of our members that only do financial, but that's a very limited set.
Yeah, no, I agree. I think this would be great if ISO could do this. The data actually is available to do this. It's public. It's very challenging to do the calculations. And, the ISO settlements people do this all the time, right? They're actually settling this so that ISO has the information. I think there's probably some hesitancy to share in like the way I've done here, where we identify specific participants, but frankly, it is public data. I mean, it could be used, but it's difficult to do the calculations.
Well, thank you. I really appreciate this dialogue, and I'd love to connect offline. I really appreciate your efforts here.
Thanks, Noah.
We do have another hand raised from Abram.
Doug, Sabram from Appian Way. One of the pieces I think Noah was getting at is that all the transactions that would have been referenced in the nodal exchange presentation earlier aren't necessarily included in your analysis, in that there's just a lot of financial transactions. But I actually wanted to make a different point, which is just around philosophically what it means to be the financial equivalent of firm transmission in an RTO context. Because what is really happened is that when you go to an LNP market, you go from having a single price at a location where everything settles there, and basically, a queue is used to ration who gets access, or non-market mechanisms are used to ration who gets access to the transmission. And you're shifting to a market where, California has 1,500 different nodes, and each generator is located at a different location, and each one has its own idiosyncratic congestion risk and is making, financial transactions with other entities. And generally, the way the market orthodoxy works is that the EQR and the zone-to-zone type transactions, that's kind of an overlay of the traditional model, where you convert that old physical model to financial, and you have locations there. But the CRRs provide the last mile in order to facilitate what would be the financial equivalent of firm transmission to get specifically to the 1,500 different generator locations and what their congestion is. So I know, for instance, I spent a long time as the head of trading for an IPP where we had a lot of basis risk, and it was very complicated to manage that. And what we would end up doing is buy a portfolio of congestion constraints that basically was correlated with our basis risk. But we often didn't always want to hedge directly to a load zone or to a specific load, because we might not have done that transaction. We may be just trying to buy a financial right that would hedge against the transaction associated with the generation pocket. So think about PAF 15, say, and a lot of the generation downstream of that. They may not have contracts specifically with load serving entities or CCAs, or they may, but they do want to have ability to buy congestion contracts that meets their specific needs. And I think, at least when I think about the term serving as a financial equivalent of firm transmission, it's trying to address that problem of having a market where it's so difficult to have liquidity and to hedge for the individual generators. And I'm sure they would love your suggestion to provide them with the the CRRs for free, but I don't think the loads would be better off even than today if you did that. But I do think that the reason we have the CRRs is very much tied up and linked to the fact that we have this LNP market. And a lot of these arguments were, in fact, why Enron, back in the 1990s, made the argument that California shouldn't go to an LNP market in the first place, because it would be too complicated in terms of liquidity of managing the individual locations and prices. And Scott Harvey can give you a lot of that history, if we ask. But a big part of the argument against moving to RTOs and LNP was that the forward liquidity would be squashed and there wouldn't be enough trading and hedging on a forward basis. And you're hearing from WPTF and some of the renewable generators in this context who've made the comments, as well as financial marketers, about how the product, when it's well designed, actually provides that financial equivalent of firm transmission and is a really important part of their business needs for participating exactly in this kind of market that provides a lot of efficiencies in terms of transmission use, but does make it a bit more complicated to manage the hedging with all the prices being different everywhere on the system.
Yeah, Auburn, I think you raised some good points, but first I do want to make it clear, I'm not advocating that we start giving away the CRRs to all.
No, I know it was a facetious comment. I don't think that the losses to ratepayers are quite that bad.
Yeah, but I mean, wouldn't you agree, though, that if a party could demonstrate that they're actually using transmission, have a need, they haven't sold at their bus bar, they want to get to a trading hub or an intertie, if they can demonstrate that they're actually injecting or withdrawing energy somewhere, that could be a reasonable way to put a limit on the volume that they can request, the volume of CRRs they could bid for.
Yeah, I don't know. I don't know. I mean, it wouldn't just be the individual generator. It would be potentially different, financial participants who transact with those generators and with the load on the other side, and those kind of entities as well. So,
exactly.
I don't know what we'd have to see a specific proposal on that kind of thing, but I tend to think that the transfer capability on the system provides a very specific, concrete limitation on how many CRRs and how much transfer capability can be sold. It's actually kind of magical. And, obviously there are problems with the simultaneous feasibility test when it's not done right, but it's not like just this random market. It's actually associated with the actual transfer capability on the system, and you're using that to provide the market with the ability to manage basis risk. All entities in the market, the ability to manage basis risk subject to the limitations on the transmission grid. Anyway.
Thanks, Auburn.
Thank you.
No other questions.
Great. Well, thank you very much for letting me present.
Thank you, Doug. We are now, well, first of all, thank you to all 5 of our presenters this morning and this afternoon. That wraps up the presentation, the stakeholder presentation portion of the meeting today. We are now going to transition into talking about goals and problem statements, including some follow-up on some of the feedback that we've received along those lines in the earlier meetings. Why don't we take a 5-minute break and come back and start that portion of the conversation at 1:55. Welcome back. Let's move into the next portion of our discussion. For this portion, I'm gonna be leading, but I'll note that we also have some representatives of our market analysis team, Daryl and Kyle, on the phone. So what we wanted to do for this portion is to touch on one particular aspect of the feedback that we received in previous working group meetings, kind of before we go into the discussion of goals and problem statements, in order to just provide a little context for where that particular area lies, because as we can see even in the discussion this morning, it's one that comes up frequently. So next slide. Part of the comments that we received after the root cause analysis meetings in February and March focused on, in response to the analysis that we already presented there, how could we build on that in order to further clarify either the root causes of revenue inadequacy and auction efficiency, or inadequacy, inefficiency, or help point us towards potentially the preferred solutions. And so we wanted to acknowledge that there were a lot of very thoughtful suggestions there about how we might build on the root cause analysis that has already been completed. And so where we sit with that today, and we wanted to kind of check in with this group on that, there's a large number of requests. We have been working through them with the multiple different teams that touch on this kind of analysis inside the ISO, and we're sorting through them to look from a feasibility perspective, from a bandwidth perspective. There are kind of a number of different variables that impact what the next iteration of analysis can look like. And so this is something that as we move into the policy development phase, there will be an opportunity to iterate and provide additional analysis. At the same time, in the more immediate conversation that we're having here about goals and problem statements, there won't be any iterative analysis coming out before that is completed. And so I hope that the goal here today for this portion is to clarify that as we're putting together the goals and problem statements, we're going to be building off of the analysis that we have today. But we do see all of the thoughtful requests for iteration and further analysis, and that is something that we can potentially get to in the policy development phase a little further on. Next slide. So as we move forward and are thinking about how to structure the next round of analysis, input on that is welcome. There are a number of constraints on what we can do around some of the requests that we received. Some of them have a relatively high feasibility, especially around looking at past revenue inadequacy, that we have some ability to provide at a more granular level than what we discussed already in the February and March meetings. So in terms of where we could start from, that would be one of the easiest areas to drill down on a little more. We also see that there has been interest in around the auction reform, or the auction reform ideas, for example, willing buyer, willing seller. We see that there's interest in trying to get a sense of what the auction and allocation results might have looked like under these alternative structures compared to what we saw under the existing structure. And this is something that there are pieces of this that are challenging, given that the data that we have today, for example, data on bids, was all created under the existing auction structure and therefore is reflected in that. But we recognize that there's interest in this. And so I wanted to call this out because this is something that we are thinking about, how we might be able to structure this and provide something that would at least partially address the questions behind those requests. So there will be more opportunities down the road as we move into policy development for input on exactly what is the highest priority, what would be most useful to see. I think we maybe heard some of that input already this morning. So I'll encourage you to stay tuned on that. We will be moving further into it in later conversations, but for today and for the next meeting, we are also going to need to distill our problem statements and goals down from the analysis we have already today. So I'll pause there. Partha or any of our market analysis team members on the phone, does anyone want to add any color to that? Otherwise, we can check for questions.
I just wanted to say thank you, Hillary. By the way, this is Kyle Pelham, this team. Yeah, thanks for the summary. I think it encapsulates the current conditions. Yeah, just thanks for that. I'm happy to address any questions and go into more detail on the revenue inadequacy side of things. It was mentioned that we can do a little bit more there. So if there's any questions, I can definitely address those.
No questions in the room. Do we have any on the phone?
No questions at this time.
All right. Well, with that, let's move. Next slide. Let's move into goal and problem statement development. This is something that we have been, this is the first time that we're talking about it explicitly with this amount of time, but we're hopeful that everything that we've provided in the working group so far has led up to this conversation, has informed and allowed us to hopefully develop some goals and problem statements that will set us up for a common ground in the policy development. So a little bit of context before we dive in on this. In terms of how we differentiate goals and problem statements, I think a goal speaks to what we want this market to achieve, and a problem statement speaks to what we're currently seeing in the market that maybe is separating us from that ideal outcome. And so the way that we're going to present this is we have, in an attempt to kind of synthesize everything that we've heard from all of the members of the working group so far, there's been an immense amount of input, which is fantastic. Also, I want to echo Partha's opening comments that we recognize there's a lot of divergence here on a number of issues in terms of perspectives amongst the working group members. And so the way that we've structured this is to go back to the slide that you have seen a couple times before to talk about kind of fundamental functions of the CRR market and the CRR product. And so we will use that as an organizing framework to talk about the different topics that have come up here, and then how we might ultimately distill them down into problem statements. Next slide, please. This is the framework that we're going to be working from. You have seen this before, and this is just a high-level summary of what the existing precedent tells us about the functions that the CRR market serves. And so we've got on the left there providing open access transmission. We've got allocating fairly the transmission revenues to customers paying the embedded costs of the transmission system. And we have allow hedging of congestion costs in the context of a day-ahead energy market. And of those three, a lot of the issues, most of the issues that we have heard about in the working group and talked about fall under those second two, the allocation of transmission revenue back to the customers that are paying the cost of the transmission system, and then the hedging function. And so those are the two that we're going to focus on the most. Of the allocation of transmission revenue correlates most to auction efficiency. We'll talk about that first. And then we'll talk in the hedging section about revenue inadequacy and also the structure of the CRR market product and the processes by which they are allocated. So before we dive into each of these individual areas, I'll pause here. Partha, do you have any other opening comments?
I think you covered it really well, Hillary, and really I think that like what we've heard mainly from stakeholders, I think through the calls, has been kind of like different ways to articulate these still being kind of the consistent goals with how our CRR framework could run, with maybe different perspectives on are there different mechanisms to best achieve these goals and to weigh the relative trade-off of these goals in the process. So love to hear from others if stakeholders wanted to weigh in on if there's different, I think we can do that probably as we get to more of the specific goals. If there's ones that we should add, will certainly be a chance in your comments to include them in. But probably we can get to as we go through each one individually, we can get stakeholder feedback on, this right. And we don't expect that we have it, perfectly right on this. We really, as Hillary alluded to, we wanted to put something out there to allow for a robust discussion by stakeholders that we could iterate on, both in this meeting and in comments and in the next meeting, before we sort of drive towards specific packages of reforms to help best meet the goals and help best close the problem statements that are identified. So yeah, really appreciate it, Hillary. Thanks.
That's a great point about the comments. I meant to put that up front too. The structure of the comments on this meeting will be, well, of course, always happy to take general feedback, but also an opportunity to redline the draft goals and problem statements themselves. And I think we saw a little bit of that even this morning in some of the presentations. Appreciate the ideas that were put forward there. So to the extent that that you have red lines to the drafts that we put up here for discussion, or would like to introduce entirely new ones, those would both be really valuable feedback in the comments on this meeting. So with that, let's get into it. Let's go to the next slide. So as I said, first we're going to talk about, in the context of the function of the allocation of transmission revenue back to customers who pay the cost of the transmission system. There are a couple goals here that fall under this, that arguably fall under this function. And this, I want to recognize that this function, we're talking about this function first because it's separate from the hedging function that CRRs also play, and we'll talk about that extensively next. But in the context of reallocation of transmission revenue, there are a couple possible goals here that we saw based on the conversation so far. One is that CRRs in the auction should be priced at a reasonable approximation of the expected payout of congestion rent in the day-ahead market. And we recognize that there are a lot of different views on this. This also touches on the conversation we've had about the definition of the auction efficiency metric. But as a starting point, and then secondly, the transmission customers should receive approximately commensurate value for payouts made to CRR rights purchased in the auction. If we are to build on these potential goals, or if we are to take these as potential goals, next slide. Looking at the conversations that we've had in the working group that map to these issues, this really is the home of the auction efficiency conversation about the structure of the current auction and the outcomes that is producing in terms of the metric we've used so far being the ratio of payout to revenue. In terms of the policy options that have come up in feedback and in comments and written comments and verbal comments at the meeting so far, this is where we would be discussing the willing buyer, willing seller model that DMM talked about this morning. It would also be the place where we would be discussing other types of auction structure modifications, such as a minimum bid or clearing price that might have functionally a similar impact of affecting what is bought and sold in the auction. Next slide. The next few slides here, I won't read these word for word, but we tried to pull out just some samples from the comments we've received in the four sets of comments so far in the working group to highlight that these are issues that stakeholders have been bringing to the table. And we had such a robust discussion this morning that some of these will be very familiar. So we look first at the conversation that's been had about how you define auction efficiency, we recognize that there are different perspectives on that across the working group. We go to the next slide. We've had feedback on the extent to which the auction results are inherently tied to the current auction structure. Next slide. We've had a lot of conversation about the impact of the current auction structure on markets and prices outside of the CRR context. So I think this came up just recently in Doug's presentation about, well, in the conversation around Doug's presentation about what the impact of the price discovery and the liquidity in the auction has in other markets. And so we have some quotes there from WPTF, BAMX, and the question at the bottom there, that is not a quote, that is just sort of a summary question pulled from the debate about the extent to which the current auction is supporting other functions that have not been quantified in the ISO market, like price discovery. You know, to the extent that there were ways to get more information about those benefits as we move forward in the policy development, that would speak to some of the questions being asked here and be very helpful. Next slide. We received a lot of feedback, again, that has some of which been reflected this morning about the auction efficiency discussion in the root cause analysis, and especially the extent to which we can draw broader trends from extreme events that tend to show really high or low auction efficiency versus those being more outliers that should not be the focus of our trend identification. I believe that is on the next slide as well. So we have some quotes there that all of the slides are posted. Welcome to go back and look, but just want to recognize that the conversation around the definition of auction efficiency and the role that extreme events play in it has been really robust, and we recognize that there are a lot of different perspectives on that. Next slide. And the next. And this brings us to the problem statements. So what you see here are, there were 4 problem statements, draft problem statements in the discussion paper that we opened the working group with in November. And we wanted to restate those here just as a recognition for those stakeholders who have been with us the whole time or others who have joined more recently. The problem statements in the discussion paper were pulled from a much smaller input pool, which was the options or the recommendations that we received in the policy roadmap in 2024 that were related to CRR topics. So that's where we started. What you see in the blue box here is an updated draft that we have developed based on all the conversations since then. So we have 2 here. The first, since the adoption of the 2019 policy changes, the ratio of auction revenue per dollar of CRR payout has improved from 50 cents to 68. However, some stakeholders have expressed that the benefits from the auction mechanism still do not fully justify the cost to them in foregone congestion rent allocation. And then the second, in recognition of some of the conversations that we've had about the role that the auction plays in the broader hedging ecosystem, consideration of CRR market changes should further explore how different types of auction participants contribute to the fair allocation of transmission revenues back to the customers who have paid the embedded costs of the transmission system. So I'll pause there. These are the 2 problem statements that, these are our updated drafts, the ones that we would request that everybody think about, potentially redline, but an attempt to capture a very complex conversation about both how to define auction efficiency and also what it means and what we should be aiming for in the future. I'll pause there. Questions or comments?
We do have a hand raised from Doug.
Hi, Hillary. Doug Boccignone from BAMX. Can you go back to slide 14, which I think is the goals, the first set? So can you explain what do you mean by the second possible goal, like the transmission customers? Who are the transmission customers? Is it like anybody who uses the transmission?
Thank you, Doug. That's a great potential clarification. What we're thinking there is that that would be the customers who are paying the cost, the embedded cost of the transmission system.
Okay, thanks. And then, so receive approximately commensurate value for payouts. Okay, great. Thanks. That's helpful.
Yeah, and we can wordsmith this, and I think we did a couple iterations on this. I think we may not have gotten it completely accurate. The idea was that we recognize the fact that there are there's other values that customers can receive just in terms of being able to obtain hedges at a reasonable rate outside of the market. So the idea wasn't directly, it wasn't just a matter of, are they getting returned equal amounts through, does the day ahead congestion match the auction revenue rights that were being paid, sort of as we did from like the, well, called the current definition of auction efficiency, but really more broadly of, are they getting commensurate benefits and commensurate value, kind of looking beyond just that more narrow look at a comparison of what was being paid for CRRs versus what is being paid out in day-ahead congestion to those auction CRRs. So that was some of the thought that we were looking at, is how to nuance that. So yeah, thanks, Doug.
No other questions.
All right, moving along. Let's see. We move to the next slide, please. We'll now move to the topics that fall under another fundamental function of CRR, or financial transmission right markets, which is allowing hedging costs of congestion in the context of a day-ahead market. And so this is speaking to a lot of topics that have come up here. We're going to separate these into two fundamental groups and talk about those separately. Those related to revenue inadequacy and the impacts that that potentially has on hedging value, and then those related to how the CRR product is designed and the extent to which that matches the hedging needs that exist in the market today. So before we get into each of those, the draft goals, what are we trying to achieve around hedging? And so as Partha conditioned on the previous one, just as a draft starting point, that the CRR market's products and processes should facilitate hedging tools and maintain the hedging value of CRRs to the extent possible. We want CRRs to be a functioning hedging tool for entities in our market who are trying to hedge congestion risk. And the day-ahead energy market participants exposed to congestion risk should be able to hedge that risk efficiently. And this speaks to, are we providing processes by which the entities that need CRRs for hedging are able to more or less get the CRRs that they need? And that's in our current structure, our allocation and our auction. Are they working for the entities that are trying to get CRRs for hedging? So let's dive into this a little bit more. First, we're going to talk about the topics related to revenue inadequacy. Next slide. Revenue inadequacy has come up in the context of how it impacts hedging. And so when we talk about why we've seen revenue inadequacy in the CAISO CRR market, and also the potential measures that could improve it, as well as the question of how we allocate shortfall, where revenue inadequacy occurs, all of that falls under this function. And so in terms of proposals that we've heard from stakeholders so far that are relevant to this function, we've got here all of the things that came up in the root cause analysis in February and March, such as the impact of loop flows and potentially modeling those in a more granular way, the impact of the shift factor threshold and looking at whether that could be reduced. We've got the impact of outage reporting and differences in outages between the monthly CRR modeling and the day ahead outcomes. We've got the tracked 1B shortfall allocation methodology. We've heard input from some stakeholders that this has impacted the hedging value of CRRs to the extent that it introduces uncertainty around what the payout will be, or even what the sign on the payout will be. And that leads us into the last item there, measures around addressing flow reversal. So all of these are related to the hedging topic, the question of how well CRRs are functioning as a hedge and how we could help them function better. If we move to the next slide. We have, again, just some samples from the comments that we've received, highlighting the interest in looking into some of these in greater detail. For example, we've got from DC the shift factor threshold. That was from comments on the root cause analysis. We have 6 cities input on the impacts of loop flow and how that might be modeled in our system in the future potentially. And then we've got Southern California Edison speaking more generally, for example, to the importance or the benefit potentially of reducing the divergence between the CRR model and the day-ahead market outcomes. So if we try and pull all this together and think about where we might start on a problem statement, we move to the next slide. The starting point in the discussion paper on revenue inadequacy, we have that up at the top of the slide there. That spoke in particular to the track 1B shortfall allocation methodology. What we have tried to come up with here is a broader set of problem statements that address the broader universe of both causes and potential improvements around revenue inadequacy. So the first one, divergence between monthly CRR modeling outcomes and day-ahead market outcomes, causes revenue inadequacy that reduces the value of CRRs as a hedging tool. ISO should evaluate and, where feasible, adopt measures for reducing this divergence, including those related to loop flows, shift factors, and transmission outages. And then the second one talks about the methodology for allocating shortfalls, where those occur. So the method for allocating revenue shortfalls should strike the best balance practicable between allocating congestion revenue back to transmission customers and maintaining the hedging value of CRRs. And we recognize there's a lot of space in that statement, and we have some very divergent perspectives on how to do that and what that best balance looks like. But as a starting point, we tried to lay that as a starting point for sort of articulating hoped for outcomes. So I'll pause there. That's the portion related to revenue inadequacy. Do we have any thoughts or questions?
We do have a hand raised online.
Abram, go ahead.
Hillary, so I think this is terrific. I think that the initial track 1A and 1B changes were focused on cost causation. And I think there are cost causation principles that can be used here in terms of how the allocation is done. So I think it would be great to try to incorporate something about, cost causation based allocation, that the allocation of revenue inadequacy should be based on cost causation principles. And the second issue I want to broach is one that I don't think was addressed yet in Guillermo's presentation from back in March, but it's possible that the having all of the CRRs be required to sync at load aggregate points and hubs, that may be, we hypothesize that may be causing some of the modeling differences, and it may have exacerbated revenue inadequacy as a result, or overselling of the transmission system. And I do think that providing more nodes to be able to sync at for whoever is using the CRR products, it doesn't have to be all the nodes, but providing more nodes that represent a fixed injection and withdrawal on the transmission grid that isn't changing every hour might actually help the revenue inadequacy problem. So part of my hypothesis is that in addition to the shift factor threshold issue and the loop flow issues, there's also a problem associated with the use of the load aggregates in the increasing use of the load aggregates after the Track 1B and 1A reforms, where there weren't other options to sync the CRRs. So I guess I'm wondering, I think that may be a major source of revenue inadequacy. I don't think it would be hard to study that, but I do think that should be on the table as a possible consideration, as a something to evaluate.
Thanks, Avram. I appreciate those are two good clarifications. So if I'm understanding you right, your feedback here would be that on the second statement there, part of striking that balance is to put in you would recommend some language about cost causation-based shortfall allocation, which would be a modification of the Track B methodology. And then in the first statement, you're suggesting that we would broaden the list of potential causes there. I see what you're saying. We call out 3 there, but we could make it clearer that that's not meant to be an exclusive list.
Sure.
Thank you.
And maybe this is not the right, if you guys want comments on these, those are general comments. I'm sure folks will provide some really good red lines once you ask for a comment. So thanks.
Yeah, this is perfect. And I appreciate that you have raised that, I appreciate you've raised that issue and potential cause in some of your earlier comments as well.
Thank you.
We do have another hand raised from JK.
Hi, JK.
Good afternoon. This is JK Wang from PG&E. So for the problem statements, we say like our initial reaction is, I think that's an improvement. It aligns well with our earlier presentation this morning from the Cal LSE group. We believe the 2019 changes are actually making improvements. So the original statement you had in the draft problem from the discussion paper, we were a little concerned that's going to be a step back. And for the updated statements, I think that reflects well, first of all, the separate treatment of the revenue inadequacy and auction inefficiency. It actually allow us to look into the problem a little bit clearer in different paths. But I do have a comment and a question and hope to gather insight. It seems that we're looking into a lot of causes. I understand these are all the things being reviewed in the KAISO's analysis, but at the same time, it seems will take a lot of time to address them all. Are we considering taking a phased approach, or like, I know earlier we also discussed the other problem statements, including improving the auction design. So what's your thoughts on this regarding the problem statements to addressing all of the problems here?
Thanks, JK. It's a great point, and I'll take a first stab at this, and Partha, feel free to add if you'd like. You've pointed out there's a lot that falls under these problem statements, and some of these would be more structural and extensive changes than others. So the short answer is we do not yet have a concrete schedule for the policy development phase in the sense of whether we would do different tracks or stages. I think that as we start to narrow down the field of changes to potentially consider further and pursue, something like that might make sense. If there are smaller changes that we could make faster that would provide market improvements sooner while we're continuing to debate more structural changes, I think that makes a lot of sense. So you've identified a really important question. We haven't mapped that out in detail yet, but I think that's something that we also anticipate debuting this summer once we finalize the problem statements and move into policy development. That would be one of the first conversations we'd have. And that would definitely be a place where we'd be looking for your input, and in terms of, are we doing this in an order, are we prioritizing the things that will be able to deliver benefits sooner in your perspective?
Thank you. That's very fair. And putting this problem statement after the auction efficiency, is there any assumptions we will address or look into auctions before we'll look into the modeling issues?
I'm glad you brought that up. No, the order that we're discussing them here today is not indicative of sequence in which they'll be considered or priority.
Got it. Thank you very much for the clarification.
Thank you.
No other hands raised and no questions in the chat.
Okay. Well, that concludes then our first group of topics under the allowing hedging in the day-ahead market context function. Let's now move on to the second one, which is looking at the design of the CRR products and processes. And so moving to the next slide. I got a little bit ahead of myself there. There they are, product design and the allocation and auction process design. And so this is an area that encompasses policy proposals that were aimed at a number of different problems. And so we've seen, running down the list here, looking back at the definition of our time of use periods, we have heard from a number of you, including CDWR at the very beginning of this process through the roadmap last year, highlighting that there's potentially special need for hedging in the super peak hours in the evening, but the current 16-hour block structure of our time of use period definitions isn't as well aligned as it could be with current hedging needs, and more granular time periods would be useful. We've heard from a number of parties, including the presentation from Vistra, for example, in January about hedging storage charging load. We recognize this is one very concrete change on the grid since we last considered changes to the CRR market structure, that the fleet of standalone storage has multiplied several times over. So we recognize that there are a number of different, there are a few different solutions that have been proposed there, including, for example, changing the eligibility of source and sink nodes for nominations, but overall aimed at allowing more hedging of storage charging load than the current rules do. We've heard input on the auction structure apart from the questions around auction efficiency. We've heard some input on auction structure in terms of the sequence of when auctions are held, and for example, looking at the balance of planning period structure that has been adopted in a couple of other ISO FTR markets that allows for auctions that cover multiple auctions over a quarter that cover the same month at increasing proximity to the calendar start date. So we recognize that some of you have provided input that would allow kind of increasing certainty in hedging needs as we approach the final month of the quarter, and that it might be helpful to adopt something like that in the ISO structure. We've heard feedback on revisiting the global derate factor and potentially allowing more CRRs to be available in the allocation process as a result. This is something that, when it was brought up, was often paired with discussion of other proposals that would, like the loop flow and shift factor modeling, that would reduce revenue inadequacy, thus allowing for more CRRs to be allocated in the allocation process without them being underfunded. And then finally, the load migration process. We've heard some feedback that there's interest in looking at that, and also potentially see some improvements on our side that could help make it more efficient. So that falls under this as well to us as part of the allocation process, since load migration is associated with CRR allocations. So we have a kind of a big net of topics falling under this question of our product definitions and the processes by which market participants can access them, serving the hedging needs that we see in the market today. Next slide. Again, we've got a couple samples here. So, for example, Vistra's comments speaking to the increased need to hedge storage charging load. We've got Vital speaking to the structure of the auctions and the potential to provide balance of planning period auctions on a different schedule, more closer to, for example, PJMs. And then we've got Silicon Valley Power speaking to the global D-rate factor and the potential to maybe replace it with something, or update it into something more targeted based on where we're seeing the constraints bind. Next slide. And that brings us to problem statements. This was an area that we received we had two different problem statements in the discussion paper last fall, reflective of the fact that we received a couple different items on this in the 2024 policy roadmap. So we had a problem statement on product definition. This one was coming in from CDWR on both the counterflow allocation process and also the time of use period definitions. And then we had the one about the global D-rate factor and the fact that it reduces the hedging value of CRRs. We have combined those into what you see here. So our updated draft reads that the hedging needs are evolving alongside the composition of the CAISO BA's generation fleet. The products available in the CRR market and the processes by which they are distributed should be updated to match evolving hedging needs. This can include revisiting time of use periods, developing measures to facilitate hedging and congestion risk associated with storage charging load, and revisiting the auction schedule. I'll also add to that, since Abram, you pointed this out in the last section, to the extent that specific potential solutions are called out here, that is not meant to be an exclusive list. So we can maybe make that clear in red lines to the extent folks have them, but the current draft there just highlights some of the ones that we've heard the most frequently in the working group so far. So a lot of different potential modifications in this category, but the overarching problem statement is trying to convey that we see that hedging needs change over time. And it's been 5 years since we last looked in on how we structure these products. And to the extent practicable, we want the products available to match the hedging needs that LSCs are trying to fill. I'll pause there. Thoughts or comments?
I'm not seeing any hands raised and no questions in the chat.
Fair enough. Next slide then. Having gone through all three of the areas, then that brings us to all of the problem statements put together. So these are the same ones that you saw on in the previous sections. 1 and 2 came from the discussion on auction efficiency. Then 3 and 4 came from the section on revenue inadequacy, and 5 is the one that we just went through now on product and process design. And so It's a lot of words on one slide, but we wanted to put them all together to give an opportunity to see. We're hoping that these can capture most of what has been brought up in the working group, which we recognize is just a lot of scope. And so between the auction efficiency, the revenue adequacy, and the product design, we're hoping that this can set us up for consideration of the main solutions and areas of common ground that have emerged as we move into the policy development process. And I think you made a really, I'm really glad you asked JK about sort of order in which these will be considered, because given that there are some distinct areas here, I think that's a decision that we'll have to make. But we wanted to make sure that the problem statements captured everything that we've heard so far in terms of the core challenges we're facing here. And the hope is that despite the broad range of views in this group, which we certainly recognize, that this can start to identify some areas of common ground on desired outcomes to set us up for policy development. Partha, do you have anything you want to add there?
One more chance for stakeholder feedback would be, anybody on the line?
Yeah, no hand raised, and no questions in the chat.
Yeah. Well, before we get to next steps, maybe I'll just offer up. I really appreciate everyone's engagement. I know we had these problem statements out there. We kind of recognize the fact that we're going to have 5 presentations, which would probably elicit, a lot of discussions around the challenges that participants have faced. And I recognize even from the discussion, today, there's probably a lot of there's diverse perspectives just in terms of the challenges, the goals, and the fixes. But we really appreciated like the great involvement by participants. Just if nothing else, in getting a common understanding of what the different positions are of parties heading into policy development. And so I'm going to interpret the silence on this slide as being at least a positive sign, but really are welcoming your feedback, because we have another meeting where we'll be able to sort of delve further into this, so we're well set up for that policy development phase. But back to you, Hillary.
Thanks, Partha. I think that also is a good segue into just as we move here into more focus on redlining the problem statements and eventually finalizing them. Like you said, thank you everybody for the perspectives you provided over the past 5 meetings. I think one of the things that has been really valuable on our side is hearing more about how you have interacted with this market so far and in the past 5 years since we made the last changes. I think hopefully the conversations that we've had leading up to this and the presentations, both from our CRR production team in January, for example, and then the other ISOs, I hope have provided some answers and clarity where you had or wanted them on how the current status quo looks and functions. And so I just want to acknowledge that as we start to focus more explicitly on problem statements and eventually policy development, please continue providing anywhere you see it's missing your thoughts on what you're seeing in the market already. There will be another opportunity at June's meeting for presentations like the ones we had this morning, just as there was in January. That's something that we're always open to and would like to continue doing as long as there are interested parties. So, and vice versa, to the extent that our conversations here bring up questions about how the current market functions, those are always welcome. But with that, seeing no further questions, we can move to the next slide. Yeah. Oh, right. We're at the next step section.
Okay, so looking at next steps, if you can go to the next slide. Comments on today's meeting will be due May 27th. And then, as we mentioned, the next working group meeting is tentatively scheduled for June 9th. And we will have that notice coming out soon, and there'll be opportunity for stakeholders to present. So if you're interested, please email us at isostakeholderaffairs@kisl.com. Next slide. And then here's a look at the meetings that are coming up this week. And all meetings are also listed on the ISO calendar. There's quite a bit this week. So next slide. Here we go. And then a comment deadline as well. Next slide. And the ISO encourages market participants to review the new trainings page on the market participant portal. In addition to the Learning Center, this new training page will be a centralized location for accessing computer-based training videos. And then for market simulations, please refer to our release schedule for the most recent updates of initiatives scheduled for MAP and production stage market sims. Next slide. And then for insights into the ISO grid and market operations, be sure to be on the lookout for Energy Matters blog. We just posted 2 new blog posts, and you can always subscribe as well. And so with that, I'd like to thank you for joining today's discussion. As a reminder, this meeting was recorded for informational and convenience purposes only. The video file will be posted to the initiative page, and you can get there from the calendar event. So thank you so much. Have a good rest of your day.
This event has concluded. Thank you for using event services. You may now disconnect.